I want to thank Warren for joining us and giving us all his time. 3 hours is it benefits us, obviously benefits viewers. If you were Charlie Sheen, I just figured out you'd make $12 million in 3 hours. So you're doing this. I don't think we're paying you that. So
no, but Charlie Sheen is paying me for being his media advisor. So I'm actually doing very well.
Some of those when he said gnarly, I said that has got Buffett's fingerprints on it. Just because you say gnarly, here's listening to you talk though, Warren. When you say, with your comments about bonds, that makes me think of financial assets in general, which includes stocks. And I think about the printing presses, not only in this country, but around the world. You've seen the commercial cha-chung, cha-chung, cha-chung with the central banks. And there are periods where financial assets are great, from the early 80s to 2000. And I just wonder if there's then periods where hard assets are great. And you see Paulson in gold and some of these other guys in gold or commodities. Are you just not comfortable with commodities? Are there times where you should be downplaying maybe stocks or businesses and going totally full bore into commodities, but you're just not comfortable doing that?
No, the alternative with me, Joe, the alternative, I don't like fixed dollar investments at all. I don't like short-term bonds. I don't like long-term bonds. We own a lot of short-term bonds, but that is not because we like them. That's just a parking place. But the alternative, in my view, I mean, certainly commodities can be an alternative, but the alternative is income-producing assets of one sort or another that are not fixed dollar type investments. And so I've said consistently for the last few years, I would vastly prefer to own common stocks than fixed dollar investments over a 5 or 10 year period. I don't know about the next 5 hours or 5 days. And that might very well extend to rental real estate. It might extend to farms. I mean, an investment, you're looking for something where you put out money now and that asset that you buy gives you back more money over time. Now, the problem with commodities is that you're betting on what somebody else will pay for them in 6 months. The commodity itself isn't going to do anything for you. So there's two types of assets to buy. One is where the asset itself delivers a return to you, such as rental property, stocks, a farm. And then there's assets that you buy where you hope somebody else pays you more later on, but the asset itself doesn't produce anything. And those are two different games. I regard the second game as speculation. Now, there's nothing immoral or illegal or fattening about speculation, but it is an entirely different game to buy a lump of something and hope that somebody else pays you more for that lump 2 years from now than it is to buy something that you expect to produce income for you over time. I bought a farm 30 years ago, not far from here. I've never had a quote on it since. What I do is I look at what it produces every year, and it produces a very satisfactory amount relative to what I paid for it. If they closed the stock market for 10 years and we owned Coca-Cola and Wells Fargo and some other businesses, it wouldn't bother me because I'm looking at what the business produces. If I buy a McDonald's stand, I don't get a quote on it every day. I look at how my business is every day. So those are the kind of assets I like to own. Something that actually is going to deliver and hopefully deliver to meet my expectations over time. A piece of art, may go from $1,000 to $50 million, but it's dependent on what the next guy wants to pay me. The art itself, the painting itself, is not going to dispense cash. So I have to find somebody that's going to like it more. And with an asset like gold, for example, basically gold is a way of going long on fear. And it's been a pretty good way of going long on fear from time to time. But you really have to hope people become more afraid in a year or 2 years than they are now. And if they become more afraid, you make money. If they become less afraid, you lose money. But the gold itself doesn't produce anything.
Well, speaking of gold, though, we're looking at gold prices, and they were at another record high. They're up another $3 today, $1,434 an ounce. And there have been some big hedge fund managers, like a Paulson or a David Einhorn, who have really buckled down on these bets. Why would you steer clear, and do you think what they're doing is the wrong thing?
Well, I just don't know. I don't know whether cotton's going to go up. I mean, we use a lot of cotton. I've watched it go from 80 cents to $1.90. We use a lot of copper, and I watched it go from $2 to $4 plus. So, I mean, there's all kinds of things in this world that are going to go up and down in price. Maybe hamburgers will tomorrow. But I don't know how to judge that. I do know how to judge, to some extent, the earning power of some businesses. And the real test whether you would like it as an investment is whether you would be happy if it never got quoted again, and just in terms of what the asset did for you. But that doesn't. I would say this about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth at today's market prices about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, you know, maybe touching it, fondling it occasionally, you know, and then saying, you know, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that. Add $1 trillion of walking around money. You know, maybe call me crazy, but I'll take the farmland and the Exxon Mobils.
All right, that makes some sense. Carl, you've got a question too?
I'm still trying to get the image of Warren fondling a giant block of gold out of my mind.
Just fondling it occasionally was what stuck with me.
Bring me a giant block of gold and you'll see me fondle like you've never seen before.
Warren, one question about my favorite line in your letter, and I'm guessing everybody's favorite line, is about your elephant gun being reloaded and that your trigger finger is itchy, teasing some investors, as some said, about your appetite for acquisitions. One of the immediate follow-ups for a lot of investors is, well, if he's so ready, what's holding him back? And with the cash levels that you have, some read into that at these levels, these multiples, Buffett's simply not interested. He wants things to really go on sale. Is that a coded message that you think stocks need to come down in order for you to buy?
No, but it makes it easier if they would come down. But we're looking, you know, as I said, we're looking for elephants. Well, for one thing, there aren't very many elephants out there, and all of the elephants don't want to go in my zoo either. You know, so I have to find an elephant that thinks being in the Omaha Zoo is, you know, the greatest thing there is in life, which of course it is, and then I have to have a feasible price for it, and obviously the lower stock prices are generally the more chance of that happening will be. But you know, it's going to be rare that we're going to find something selling in the tens of billions of dollars where I understand the business, where the management wants to join up with Berkshire, where the price makes the deal feasible, but it will happen from time to time, and it'll happen more often when stocks are depressed than when they're buoyant. But we are not, even though stocks have gone up close to double from when we were here 2 years ago, stocks were really cheap then, when we talked about it then. Now, you know, people were scared, but stocks were cheap. They're not as cheap now as they were then, but compared to most assets, they look attractive. And so it is not the level of the stock market that's scaring me off. It does make it more difficult to make deals now than it would have been 2 years ago. But we only need one.
Do we still have more time, Beck, or do we got to, do you know, for this?
I know that they want to go to a break in just a minute to come back, but we're going to continue this conversation because this is obviously pretty fertile ground. A lot of our viewers have questions about this, and I know Joe Carl and I have quite a few questions too.
I want to ask him just a quick follow-up too on. Because let's just wait. Now I'll ask him a follow-up too, because you do get paid back with your investments in dollars, and if those dollars are, you know, are going to be worth much less in the future, then I figure you must figure policymakers are going to get it together eventually, Warren, or else you know, paper money is not going to be worth anything.
Well, but that's true of if you're training to be a lawyer or you're training to be on cable or anything else, you're going to get paid in dollars. Now the question is, if you have something valuable to offer, even if the dollar gets worth less, you will retain earning power that's commensurate with purchasing power. And Coca-Cola, in the years since I was born, the dollar has depreciated 94%. I mean, it's 16 for 1 in terms of inflation. But if you owned Coca-Cola in 1930, you've still done pretty well. Or if you owned a lot of good businesses in 1930, because they have the ability to extract real earnings in terms of what they deliver to people. And your doctor is able to charge 16 times as much as in 1930 because his services are still as valuable. So as the currency gets worth less, it does not penalize the service or the good that is really needed by other people. The world adapts. And that's why I like businesses, or I like my own earning power as the best assets in a time of inflation. They really can't be taken away.
Warren, you started talking about how you've got an itchy trigger finger. I even saw you kind of moving your finger around like you're ready to shoot something. Do you have any irons in the fire right now?
We had an iron in the fire that got taken out of the fire just a day or two ago, which did a deal that did not, somebody else beat us out on it. And I've always got a gleam in my eye. You know, I'm always looking at the girl, but the girl may not be looking at me. I mean, that's my problem. But we will always have something that is at least a very, very, very low possibility. Somebody that's talked to me and says, you know, I'll see what my board thinks, or who knows. But we certainly have nothing that's a high probability at the moment.
Was this thing that you just talked about, this deal that was potentially there, was it an elephant?
It was maybe a zebra, you know, sort of. It was big enough to fit to make the zoo more interesting, but it wasn't one to cause, you know, new crowds to come out.
Okay. So it's not as big as Burlington Northern.
No.
But it was something that was substantial.
It was something that caused my heart to beat faster.
Okay, we're going to talk a lot more about this, because ever since you mentioned that you have an itchy trigger finger in your annual letter, it's got all kinds of people trying to speculate, figure out what you might be interested in.
But I would say this, Becky, I've had an itchy trigger finger all my life. I mean, I got a free ad out of it in the annual report this year.
Okay.
Let's go down to the floor. Andrew Ross Sorkin is there with a very special guest this Friday morning. Morning, Andrew.
Good morning. We are here with the one and only, the Oracle of Omaha, Warren Buffett. We're also here with Carrie Barron-Tamras. You're here for the 50th anniversary of Business Wire, so congratulations to you, Kathy.
Thank you so much.
I want to get to you in a second and this anniversary, but I also want to get to buybacks, which were in the news this week. You just announced it. Why do it now? I think there's a big question. Buffett watchers who've seen you over many years, you have not always liked buybacks. So what is it about what's going on right now?
Price to value. I mean, the only time to do buybacks, in my view, is when you think your stock is selling well below its intrinsic business value. And we've talked about that in many annual reports over the years, and we haven't had very many opportunities to do it. Now we think that...
Okay, so you've instituted the program, but the big question that viewers want to know is, have you actually started buying yet?
We actually have.
You have started buying yet? Okay.
Yeah.
And how much can we expect for you to buy? I know you said that you wanted to keep a $20 billion kitty at all times. You have about $40 billion on hand right now.
Yeah. Well, we don't have quite that much, but the cheaper it is, the more aggressive generally we will be in terms of buying. It's just like buying any other stock.
And how much have you bought so far?
We only got the paperwork done yesterday.
Okay. And what does this say, and then I want to get to Kathy, what does this say more in a larger picture about your ability to find elephants? You always talk about your
That's what I'm looking
finger.
for. Yeah.
No, I know that, but in terms of moving money into your own stock, does it mean that you're not finding the same kind of opportunities right now, given the markets?
We find opportunities periodically. I mean, we did the B of A deal. We did Lubrizol. We put almost $9 billion in Lubrizol. We just announced yesterday a $400 million acquisition for an insurance company, just yesterday. We bought, in the last quarter, the current quarter, we bought net $4 billion of common equities, which was similar to the total amount we bought in the first half. The cheaper stocks get, the better I like to buy them, whether it's our stock or somebody else's.
So we should still see you make a big deal, and this is not the buyback is not an announcement that you're taking money into your own stock.
No.
Okay, Kathy. Mr. Buffett bought your company in 2006. You've lasted 50 years through all sorts of different business cycles, and yet we're living now in the age of the internet and Twitter, and the SEC has now told companies that they can actually put their press releases up online. What do you do to defend your business and, frankly, to grow your business in this environment?
Well, actually, our business is growing in this environment. We also are creating websites for companies that want to put their releases online, but that's not the way to put out breaking news, and that's what we do at Business Wire. And as long as we can push that news out to the investing public, I think it's the best way to go.
If I want to know what's going on at Bank of America, I do not want to have a website tuned to that all day. I want to get it instantly from CNBC, and the way they'll get it is, is from Business Wire.
I would be remiss if I didn't mention that one of the other reasons you're in town is for this Obama fundraiser tonight at the Four Seasons.
Yeah.
And I wanted to ask you specifically, so many people in the business community say that the president is anti-business. Do you believe he's anti-business when you think about his rhetoric, and why not?
Oh, well,
rhetoric and policies, by the way. There's so many people who say...
I mean, he took action to save General Motors and Chrysler. I mean, he backed programs that have kept the banks around and in the process rejuvenate the economy. He knows, and he knew it 10 years ago. Be president of the United States, particularly the second term, you better have business doing well, and he wants it to do well.
The talk of higher taxes and more regulation, you don't think is creating more uncertainty in the business community?
I don't.
What do you tell the CEOs who talk to you about this?
I don't have any uncertainty. We are investing at Berkshire a record $7 billion in plant and equipment this year. Never before that much. 90+% is in the United States. We're seeing our businesses doing well. Business is coming back in the United States.
Okay, let's talk about the Buffett rule for a moment. Talk to me about how it came about in terms of the White House getting in touch with you and you putting your name to this.
Well, Gene Sperling called and said, "Can we use your name?" And I said yes.
Are you happy you said yes?
Sure. I mean, I wrote about it.
But are you happy with the way it's been described? Is the program that the White House has presented $1 million and over your program?
Well, the precise program, which will... I don't know what their program will be. My program would be on the very high incomes that are taxed very low, not just high incomes. Okay. Some guy can make $50 million a year playing baseball, his taxes won't change. Make $50 million a year appearing on television, his income won't change. But if they make a lot of money and they pay a very low tax rate, like me, it would be changed by a minimum tax that would only bring them up to what the other people pay.
Okay, so does that mean that you disagree with the president's new jobs proposal, which will be paid for by raising taxes on households with incomes of over $250,000?
That's another program that I won't be discussing. But my program is to have a tax on ultra-rich people who are paying very low tax rates, not just ultra-rich people. And it would probably apply to 50,000 people in a population of 310
Okay, but that means you disagree with the president on the 250,000.
No. You may disagree with him. I don't know.
I'm asking you, so you agree the $250,000 is the right number?
I will look at the overall plan that gets submitted to Congress and which they are voting on and decide net, do I like it or do I not like it? There's no question there will be parts I'll disagree with.
And are you a supporter of his jobs program right now?
I am a supporter of the action he's trying to get the Congress to join him in taking to really do something rather than sit there and go in different directions.
But you agree with all the details or no?
Oh, I haven't looked at all the details.
Okay, fair enough. Kathy, one of the conversations that we have always about Berkshire is succession. It is an issue. And as someone who understands the culture of this company so well and what Mr. Buffett has done for it, I'm curious if you could pick his successor, what kind of person would it be? Who would it be?
Well, I don't want to think about it. Since you're making me think about it, he's irreplaceable in terms of who he is. I think I'm not privy to what's going on. That's at the board level. But it's got to be somebody that knows how to motivate people, because the one thing that Warren Buffett does, not better than anything else, because he's the capital allocator.
Can the culture remain the same?
Yes, because there are so many people throughout the organization that live and breathe the culture that Warren has created, and it's infectious. I feel it myself after 5.5 years in the company. The culture will go on.
Right. Now, you recently hired Ted Welschler to be one of your investment managers.
Right.
Some people have speculated he actually could ultimately be a CEO. He's not just been an investment manager, but also an investment banker and has worked in corporate America. How should we think about him?
We got a lot of talent.
You got a lot of talent. And will you be, you have two. You've suggested that you will go for it, that you would have three in total.
Possibly.
Do you have a name already in your hat?
I've got a couple in my mind, but I'm very happy with the two. I'll be happy if we have a third. It's not essential at all. But
and none of those three, do you think, will become the CEO of the company?
Hard to tell.
Final question. Berkshire Hathaway, long thought of as a play on America, given the industrials and how much that represents. So many people say we're going back into a recession. You say what?
Oh, we're not going. I think it's very, very unlikely to go back into a recession. We're coming out of a recession, and we've been doing it since 2009. And a great majority of our businesses are going to be earning more money than they did last year and the year before.
How much are you worried about Europe impacting and infecting actually Berkshire's business and our economy?
I don't worry too much about it infecting us. I worry about what will happen in Europe, and it's bound to have some fallout here. How it plays out, nobody knows. All I know is our businesses 5 years from now and 10 years from now, and the country's businesses will be doing a lot better.
You own some German bonds?
We own German bonds. We don't
German
own
bonds?
Yeah.
What kind of haircut you want to take on those?
On German, no.
You think you're okay?
We have a German reinsurance subsidiary that's owned those bonds for a long, long time, and we're fine with them. But we sold other countries.
Bank of America.
Yeah.
Big deal for you. Brian Moynihan, since you made your investment, a lot of things have happened there. Did you expect those things to happen the way they have in terms of layoffs and everything else?
I expected him to clean up a lot of the problems from the past, and they're going to take a long time to clean up. I mean, 2 years from now and 3 years from now, you'll still see some headlines.
And your bet is that the company not only survives but thrives,
Sure.
or you're just making a bet that it sticks around and you're going to get your dividend?
It's a great underlying business. It's a fabulous underlying business, but it's got a lot of problems from the past. Brian didn't create those. He has to clean up the mess. But I've been in those kind of situations before.
Fair enough. Warren, thank you so much.
Okay, thank you.
Kathy, congratulations on 50 years. Let's hope there's 50 more. Back to you guys. Thanks so much.
So Andrew, has he invited you to the dinner tonight?
I have not been invited. Warren has not invited me. Am I invited to the dinner tonight?
No.
I don't know how much that plate costs, though.
Get out your wallet here.
Yeah, I got to get my wallet out. So. Anyway, back to you guys. Thanks.
We're very selective. All you have to have is $1,000 or 35.8
with Warren Buffett.
Yeah, Joe, I saw gold was down, but I haven't seen by how much this morning. I don't know if you've seen a quote on that. But
dollar
you were
strength,
just
I would
talking.
think. Yeah.
Yeah, you were talking a little bit about gold prices. Obviously, that's something. Yeah, okay, it's down about $4, 1641. Obviously, it's a huge question people have asked as we've seen a big run up in gold over the last 4 years or so, and that's something that was definitely talked about this weekend here at Berkshire. Joe just talked about Charlie Munger's comment that civilized people don't buy gold. This weekend, I also got the chance to sit down with Berkshire board member and Microsoft chairman Bill Gates, and he's not a huge gold fan either. Listen in. Gold today was something that both Charlie and Warren made pretty clear they're not a big fan of. What about you?
I'm certainly in that camp. Historically, I did have some silver investments that at a time Warren actually had some silver investments. He got out fairly quickly. You know, I stayed in and did very well on silver. But, you know, gold is a very tough one because it's so psychological. And if central banks or the IMF ever decided to take advantage, and I think countries need liquidity, you know, hey, there's an asset that's not doing anything for the citizens, and then you know, because it's purely psychological, it's not like people would say, oh, well, when it gets to $800 an ounce, people will buy 4 times as much jewelry. There's no, nothing that steps in as a buyer at any price. It's just purely, oh, other people in the future will think it's worth more than it's worth today. Which, you know, if you think the world is scary and people are going to panic, I'm not saying that theory doesn't exist, but there is no floor if ever people got a view. And you do, we had a invention session with some people recently. As this price gets high and you look at a 10 to 20 year time frame, the supply equation will change. And so the bulls have to offset the fact that there'll be quite a bit, not in the near term, but over a period of time. And these people are claiming that they can predict, you know, gold prices out into the future, which certainly with equities you can feel like you can. Well, there you have to understand the innovations in digital mining techniques or some new extraction techniques, which actually I think are pretty interesting, and I doubt many people factor that in.
All right, we've never even talked about the supply picture, but he's talking about eventually being able to increase the supply of gold. You had a shareholder who asked you a question about gold over the weekend, and your response was pretty interesting. Berkshire versus gold. You want to talk about how that's performed over the years?
Yeah, but we can go beyond that. But certainly, when we took over Berkshire, Berkshire was selling at $15 a share, and gold was selling at $20 an ounce. And gold is now $1,600, and Berkshire's $120,000. But you can take a broader example than that. If you buy an ounce of gold today and you hold it 100 years, you can go to it every day, and you can coo to it, and you can caress it, and you can fondle it, and 100 years from now, you'll have 1 ounce of gold, and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it, all kinds of things. For 100 years, it'll produce things for you, and you still have 100 acres of farmland at the end of the 100 years. You could buy the Dow Jones Industrial Average for 66 at the start of 1900. Gold was then $20. At the end, it was 11,400, but you'd all gotten dividends for 100 years. So a productive asset of any kind, a decent productive asset, is going to kill a non-productive asset over time. Now, in any given 1 year period, 5 year period, any asset can outperform another asset. Tulips.
Why don't you join me, Warren? Why don't you join me and buy some cows? I mean, I like your farmland, but you're in Nebraska for Iowa. You love steak. I mean, we can have leather. We can have manure. We can have milk. We can have meat. We'll employ people.
You can have the manure. I'll take the meat.
I've got plenty of the manure. No, but we'll employ people taking care of the cows. I mean, that little bar of gold that's worth 50, whatever. We had one in here. Look, I think it was worth like $60,000 or $70,000. I can get like so many head of cattle for that and be productive. That was my point. But you like farmland. You just too lazy to take care of the cattle or something? Pay some people.
Absolutely. Have you ever tried to take care of cattle, Joe?
It must be. I think it might be hard. I know I've tipped a few, but I've never.
Have you tipped?
No, I've never done it.
I hope you have not, Kit. That's mean.
It's cruel.
It is cruel.
They're sweet. They're sweet, but they're not too bright. Like me.
With land, you can get somebody else to do all the work, give them a percentage of the crop, and you can sit back there for 100 years and get a percentage of the crop, and you still got the land when you get all through. I will guarantee you that farmland over 100 years is going to be gold, and so are equities.
Why do you think gold bugs get so irate? Because they really come out.
Yeah, it's very interesting. If you go on CNBC and say that bonds are kind of a poor investment, people don't get mad at you. You don't even hear from the Treasury. I mean, you can knock almost any investment, and people may get a little irritated. But when you talk about gold, and of course that says something about their motivations for ownership. They want people to agree with them. They want everybody to get so scared they run to a cave with gold. And caves might be a better investment than gold. I mean, at least they're not producing more caves all the time. So they want people to be as afraid as they are, because that's what's going to produce an increase in prices. Incidentally, they're right to be afraid of paper money. I mean, they have their basic premise that paper money around the world is going to get worth less and less and less over time is absolutely correct. But
you just disagree with the investment theory beyond that.
Yeah. Where they run from that, and they should run from it, is where, in my view, they make the mistake. But they have a correct basic premise.
Okay. Guys, we'll send it back over to you. We do have a lot more coming up.
Now let's switch on the Power Lunch Power Surge and drill down on the stories driving the day. Contracts for home sales hitting a 2-year high, and billionaire investor Warren Buffett telling CNBC that's where he would put his money. So what's fueling his optimism? Diana Olick is in Washington with some of the details. Hi, Diana.
Hey, Sue, the numbers are going up, and that's enough to fuel optimism in this market. But remember, we're coming off some real historic lows here in sales. That said, though, the numbers today, based on contract signs, not closings. Pending home sales rose 2% in January from a downwardly revised December figure. The pending index is up 8% from a year ago and hitting highs not seen since 2010, when the homebuyer tax credit was in play. One caveat is that cancellations are running historically high at 33% in January. So all these pending sales will not necessarily turn into closings. Now, as for the optimism, at least on the part of Mr. Buffett, it appears to be all about affordability. Record low mortgage rates and bargain basement prices are leading him to say, if you can, get in.
if I had a way of buying a couple 100,000 single-family homes and had a way of managing, the management is enormous. It was really a problem because they're one by one. They're not like apartment houses. So, but I would load up on them.
Now, you'll note here that his optimism is an investor taking advantage of these distressed properties to turn them around as rentals. That, of course, implies that he doesn't expect rental demand to fall off anytime soon. So while sales have begun to rebound, home prices have not. We'll, of course, get the latest reading on prices tomorrow morning from S&P Case-Shiller, and expectations there are not quite so bullish. Sue?
Diana, if, as Mr. Buffett says, it's such a great time to get in and buy, what's holding back the bulk of the ordinary market from getting in?
Getting a mortgage, Sue. That's what I hear every single day. A lot of folks are not qualifying for those low rates on mortgages. They either don't have enough money to put down or they don't have enough credit. And that's leading a lot more buyers to be all cash buyers. In fact, we saw a new study out today that saw a big jump in the number of all cash buyers. And I'm not talking about investors. I'm talking about repeat existing home sales buyers to occupy those homes. The study found a big jump from October to January because people need to use cash to get in on these deals.
Diana, thanks a million.
Okay, more with Warren. I'm going to just ask one thing, and then I'm going to let you ask more things.
Okay, go for it.
Is that cool? All right. So, Warren, I'm thinking back to the pipeline and to infrastructure in general. And I'm trying to figure out what you feel about infrastructure, because the way you answer that question about the pipeline in that, well, you know, they talk about jobs here, they talk about jobs there. See, to me, that seems like just crucial infrastructure, that if we're going to do something, that'd be great to bring oil in from our friendly neighbors to the north. It helps with our relations with Canada. We're not going to get off carbon anytime soon. So it made a lot of sense to me. I'm wondering, because of your answer to that, do you think other infrastructure projects are sort of the same? Because that seems like one we could actually use. Building high-speed rail between cities where people don't even want to go, or some of these other ideas, Solyndra, I don't know. That type of infrastructure seems even less, makes less economic sense than the pipeline did.
Yeah. We will spend at BNSF $3.7 billion this year on the railroad, and a lot of that's what you'd call infrastructure. In fact, and that's by a large margin more than we've ever spent. One thing you'll get a kick out of if you talk about infrastructure, we actually had to build 6 bridges in connection with because of the floods that took place here. The floods were really tough this year, particularly on our railroad. And Matt Rose, who runs BNSF, knowing how Charlie kind of grimaces whenever he hears about capital expenditures, he has named one of those bridges in Iowa the Charles T. Munger Bridge. We've even got a plaque put up there. So Charlie now has a bridge named after him. I don't have a bridge named after me yet.
How much of a role? It's amazing that a private company is building all that infrastructure. But what's the role of the government in terms of stimulus and the jobs plan? What's the role there for infrastructure? If you didn't think the pipeline makes sense, what makes sense for the government to be involved?
I'm not saying the pipeline does. I just don't know. I don't know the weight of the two arguments. I don't know that much about soil. It's just a subject like a whole lot of things that I don't know much about. But certainly, in terms of stimulus, infrastructure is a very, very logical place to spend real money. I mean, if you decide you're going to run a government deficit and a large one, and to act as a stimulus, and you've got the kind of needs we have in this country in terms of all kinds of infrastructure, that's basically a good idea. Now, I will say this. We bought the entire BNSF equity. We paid about $33 billion for, about maybe $10 billion of debt. So call it a $43 billion total purchase. For that, we got 32,000 miles of track. We got 6,000 locomotives. We got 13,000 bridges, all kinds of things. I think in California now the number's up to 90 billion or something like that for 800 and some miles of track. So you can do the math.
Hey, Warren, just to change topics real quick, while you've been on the broadcast, Bank of America just announced this morning that it sold 10.4 billion shares of China Construction Bank for a pre-tax profit of $2.9 billion. You're an investor in the preferred shares, of course. Curious what you think of about the future of the company, and also, more importantly, investors who watch you and watch you make these investments in preferred shares, should they be following you into the common shares?
Not necessarily. And go back to the the sale of the Chinese stock. Brian Moynihan, I think, is doing a terrific job in going back to basics. Bank of America, went off in 100 different directions, and a couple of them, such as Countrywide, are going to be ungodly expensive before they get all through with it. That's got nothing to do with the present management, and Brian has the job of cleaning up some of the problems of the past. Not that the Chinese bank itself was a problem, but in terms of getting the capital in line with the total assets, he does have a problem that needs working on it, and he's been working on it. And one way to do it is to sell extraneous assets to bring down the liabilities to some degree. You can bring up the capital, but you can also bring down the liabilities. He's been doing both. He is following a very logical path. He can't do it all in a week or a month or even a year. I mean, the legacy problems that he got handed are significant, and they're not, in many cases, they're not capable of immediate resolution. But he is doing the things quite promptly that he can do things where he can do things promptly, and I think he's making a lot of good decisions.
The Wall Street Journal criticized him in an article last week for flip-flopping on a lot of these issues, for deciding to pull back on the ATM fees, the $5 ATM fees, for deciding to go ahead and buy shares after saying they wouldn't, or to issue shares after saying they would not issue additional shares. They said in the end it was the right decision, but he should have gotten to those decisions more quickly.
Well, he's had a dynamic problem. I know when I went into Solomon, I found out a lot of things in the third month I didn't know in the first month. And when you have problems to clean up, when American Express had problems in the 1960s to clean up, when Geico had problems in the 1970s to clean up, when Solomon had problems in the 1990s to clean up, usually the problems are bigger and more longer lasting than you think, but they also are solvable. And it takes time, it takes a lot of effort, and it takes a lot of grief, But if you have a wonderful underlying business, which the B of A does, which Geico did, which American Express did, you'll get them resolved if you have somebody there who puts their nose to the grindstone and does it. In terms of the go ahead.
Well, Warren, I just wanted to go back quickly to the preferred versus common issue, and you said something very interesting, which is that when you make an investment in preferred shares, that doesn't necessarily mean that shareholders should rush to go buy the common. Is that right? And I ask it only because so many people who do give you these tremendous deals do it in part to quote unquote rent the Buffett name. I know that when you invested in Bank of America, my mother said, "Can you believe Warren Buffett just invested in Bank of America? Maybe I should buy shares." And I said, "Mom, you don't understand. He's buying a different share than you would be buying."
Yeah, but I'm buying a different share in several ways, though, too, than she buys, in that I was buying something for $5 billion where we had where we contractually were not allowed to resell it for 5 years. So in the sense, we were putting money in where we couldn't change our mind next week or hope that it bounced up or anything like that. We were putting money in saying that in 5 years, we think this is plenty good. And that is a real vote of confidence. I mean, it's not a vote of confidence to go out and buy, to buy 100 shares of XYZ and sell it the next day. But when you put $5 billion in and you can't take it out, you can't touch it for 5 years, I think that is a valid vote of confidence. It doesn't mean that the common is a buy or a sell or a hold or anything else, but it does mean that we felt very strongly that the B of A was going to get rid of its legacy problems over time, and it'll take plenty of time, and that the underlying deposit franchise and business they have is a terrific business.
We are again here spending the morning with Warren Buffett, and as we mentioned, we're at the Durham Museum here in Omaha. We're in front of a mock-up of the Ernest Buffett grocery store, which is a store Mr. Buffett knows well. He worked there himself as a youngster. And Warren, thank you again for being with us this morning.
Thank you. That was the last time I did any real work, actually.
Since then, it's gotten a little easier?
It's much easier. The only thing I learned from that store was that I didn't like hard work.
Well, that's a good way to grow up and a good way to figure things out. I don't know if you just heard Carl and Joe talking a little bit about the markets and the situation yesterday. Oil prices seem to have been dictating where the market's been headed for the last week and a half or so. Do you worry about oil prices? Do you worry about what's happening in the Middle East?
Well, you may worry as a citizen about what's happening, but in terms of our investments, it doesn't have anything to do with where Geico or Coca-Cola are going to be in 5 years from now. I am just no good on day-to-day or week-to-week, month-to-month stock prices, and fortunately, I don't have to be.
Yeah, Joe just mentioned that we spoke with someone yesterday who said the oil market's doing exactly what it should be, which is overreacting. He used to run Saudi Aramco, and it's an interesting position. Even though you look at these prices, we've heard from Bim Bernanke and others that this is not something we need to be concerned about yet. Is that where you come in on this?
Well, I just don't know the answer on that. I mean, that would depend on events in the future. 6 months or 8 months ago, we weren't worried about cotton prices at Fruit of the Loom, and they've gone from 80 or 90 cents to $1.90. So you just don't know about commodities. If they get short and people need them, I mean, we have to make T-shirts and briefs and that sort of thing, and if there isn't enough cotton around in a given month, we buy it regardless of price. And oil is the same way. The demand is pretty inelastic in the short run. So if you get any real interruptions in big supplies of oil, and I know there's excess capacity around, but a big enough interruption could cause a big change in price.
We have not seen a significant interruption yet, though. The Libyan oil market maybe is 2% of the global supply, and maybe about half of that has been cut at one point or another. And yet you see oil prices running back up above $100. That's where they were trading yesterday in the extended hours. Is that something that you think is tied to speculation? Is that something that is or could be prevented, or is this a real supply situation?
Well, it isn't a real supply situation yet, but markets anticipate, and if people are not worried about Libya getting cut off, what they're worried about is that the unrest spreads and that some 3 or 4 million barrels a day would get cut off, and that's a rational thing to worry about. What the probability is of it happening, who knows? But it isn't zero. And it looks higher now than it would have looked 2 months ago, so that starts gets reflected in prices. Markets anticipate.
Your annual shareholders letter that you just came out with on Saturday painted a much more optimistic picture of America than many people had been thinking to this point. Why is that? Why are you so positive?
I've been optimistic on America right along, as you know. I mean, I was optimistic when I knew things were going to go to hell. but things do. America gets off the track from time to time, and it was particularly so in the fall of 2008. But you can't stop this country. I mean, we have gone through, 15 recessions, world wars, civil war, you name it. And there is a resiliency to the American system. It does work. And it sputters from time to time. It'll sputter from time to time in the future. But you don't want to get too concerned about that. It's kind of like having a bad crop in farming. If you've got some good land here in the Midwest, you're going to have a bad crop occasionally, but you're going to have mostly good crops. And we have great soil for this country, metaphorically, and it works over time.
So what are you seeing in your businesses right now? You said that we're back on track, but are we chugging along? Are we inching along? How are things coming?
It's probably closer to inching in most businesses. And in residential construction, it's not inching. It's not going at all. But so you do have this uneven situation. We have a few businesses that are really kind of booming, and we have a great many businesses that are moving forward, and then we have a few that are stuck. But I think that's true of the economy. But what we've seen now for almost 2 years is we've seen it getting better rather consistently, but not at a dramatic pace. And what has been interesting to me is that the sentiment has gone up and down quite a bit during a period when you really haven't seen that much change in the underlying trend.
And in terms of your businesses, you say you have some that are booming. Which ones are those?
Well, I mentioned the annual report. We've got an electronic component distributorship and a company called TTI, and they're booming in Asia, they're booming in Europe, but they're booming in this country. And they sell these little things that cost, a couple of pennies. It's like selling jelly beans or something of the sort. But they go to all kinds of customers. And their business has never been this strong. The railroad business has picked up. It's about 60% of the way back from the bottom. If you take the top in car loadings, take it down to the bottom, we've come about 60% of the way back. So there's a considerable ways to go there, but it's a different business than it was 2 years ago, and it gets better by the quarter as we go along. We see our machine tools, small little tools that go in big tools, a company called ISCAR. I just got the January figures, and January was a record month, and now not by a huge margin, but it just keeps getting better month by month. So, and nobody's buying those to put them in their homes, or for speculation. They're buying them because they're using them.
When do we see that actually play out in the jobs market? That's been the huge concern. We've got another jobs report that's coming up on Friday.
Yeah, our business at Berkshire was quite a bit better in 2010 than 2009, but we only added 3,000 jobs, from 260,000 roughly on a base. So we added 1% to jobs net, and yet our business really improved quite a bit more than that. And there were real gains in productivity achieved on the downside. People, when they really had to tighten their belts, they found out they could do it. I think that period is largely over. I think the gains in business will be much more reflected by gains in employment going from this point forward than they have in the first year and a half or 2 years of this recovery.
Does that mean good news by the end of this year, or does that mean good news by next year? Because depending on whose forecast you're watching, the unemployment number could go down significantly this year, or it might take 2 years.
I really don't know the answer on that, but if you ask me just to guess, I would guess that by close to the election of 2012, that unemployment would be probably in the low 7s. And then how good that'll look to people, I don't know at the time. But that'd be my guess from what I see in business.
You mentioned that the housing businesses you have are not inching along. They're stuck. You also said, though, in your annual letter that you think housing is in a position where a year from now things might look considerably better. Tim Geithner was on the Hill yesterday. He said there's still a lot of pain to work out in housing. And you had 9,400 employees that you had laid off in those businesses that cater to housing. So when do you think you can actually start hiring back there?
Well, we'll hire when housing starts to pick up. And they've been now in this 550 or 600,000 range for quite a while, and they needed to be. The demand for housing comes from household formations. And household formations are running considerably higher than housing starts. So the excess housing supply is being sopped up, not at an incredible rate, but at a significant rate. And that's a counterbalance to the fact that we were building 2 million housing units, and people they weren't creating 2 million families a year at that time. So we were just building too darn many houses, and they don't go away. So the only way to solve that is to underproduce compared to household formations, and we've been doing that for a couple of years, and that's why my guess is that in about a year that we will have sopped up the excess supply. Now that doesn't mean there's not all kinds of people who want to sell their house for what they paid for it 5 years ago, but that's a whole different question. I know housing will pick up at some point, and it seems logical to me that it should pick up in about a year based on the number of units that are getting sopped up. And it's a good thing. I mean, we had that one incentive there for a while to try and move houses.
Tax break for first-time buyers.
The real thing to do is clean out the excess inventory. And the only way you clean out excess inventory, you either blow up the houses or you produce fewer than households are getting formed. And any artificial acceleration of demand, it just means disappointment later on.
So you didn't think the government should have made those moves?
I don't think that. Trying to move the fourth quarter's demand into the first quarter is probably not a good idea. We had to clean out the excess.
We're just getting to the end of a lot of government programs like that. Not only what we saw with cash for clunkers, with the first-time buyers tax credit or tax deduction that would go in. You also are getting to the point where QE2 is nearing a point where it's going to end. Now, Ben Bernanke was on Capitol Hill yesterday, too, and he did not give any indication that they'd be ending QE2 early, but it only goes through June. So what happens to the markets? As you said, they're very forward-looking as they come to the recognition that Treasury's not going to be there, or the Fed's not going to be there to prop up the Treasury market anymore.
Well, I do not like short-term bonds, and I do not like long-term bonds. And if you push me, I'm sure I don't like intermediate-term bonds either. I just think it's a terrible mistake to buy into fixed dollar investments at these kind of rates, and I've thought so, for several years now. When people ran to cash because they were afraid of everything, they were really going to the worst investment, that's possible. I don't know what will happen with Treasury markets, but we have had, and I don't think people necessarily realize, we've had monetary policy with its foot to the floor for a couple of years, and we needed that to get out of where we were. How long we needed it for is another question. But the idea of overdosing the patient 2 years ago was a terrific idea. The patient needed every bit of morphine or whatever you put in them that they could take. We came on with fiscal policy very strong. And what people don't realize about fiscal policy, we talked about a stimulus bill a couple of years ago. But a stimulus bill isn't a stimulus bill because you stick the word stimulus on it. I mean, you can call any bill that spends money in Washington a stimulus bill. Stimulus is spending more money by the government than it's taking in. We are going to do that to the tune of 10% of GDP this year. We have massive stimulus going on in the United States, stimulus like you haven't seen since World War II. We just don't call it a stimulus bill. But stimulus is the federal government spending way more money than it takes in. And you can call it a stimulus bill, you can call it the green flowers bill, but whatever causes the government to spend a lot more money than it's taking in is stimulus. And when you get to 10% of GDP, you've got massive stimulus. So you've got massive monetary activity, you've got massive stimulus activity, and then what I think is the most important factor in coming out of the recession is sort of the natural regenerative capacity of capitalism. I think the other two can be important, and I think they're psychologically important because people expect the government to do that, and they wouldn't have confidence if the government wasn't doing it. But I think the main thing that makes the economy come back is 300 and some million people trying to figure out how to live better tomorrow than they're living today.
That sounds like an argument for an end to this. You said, is there too much? You said we needed it then. Have we needed QE2 in some of the latest doses?
I don't think we need as much either monetary or fiscal stimulus as is going on. I think we needed, the American public, the whole world needed to see 2 years ago that the federal government, when the world was going to try and deleverage and people were panicked over every kind of financial instrument, they needed to see the federal government was there big time. And the government really did its job there in the fall of 2008. They threw in everything, and that was hugely important in getting across to the American people that the government was not going to stand idly by while the whole machine came to a stop. But in terms of the recovery going on now, that recovery is going on because we've got 70-some managers at Berkshire trying to figure out how to do more business tomorrow than yesterday. And just look at what Apple does, or you name the company, or Amazon. They are thinking all the time of how to get their customers to do more things with them.
Let me ask you real quickly. Joe has a question too, but I just want to pin you down on this and make sure I'm not making assumptions or putting words in your mouth. You think QE2 should end now?
If I were, I have enormous respect for Ben Bernanke. He knows he knows more about the Fed than I do by a factor of 100 to 1. But in the end, I don't think we need more of that now.
If you missed Squawk Box this morning, do not worry. We have you covered with the very best of Mr. Buffett.
We sure do, and it's great to have Becky with us as well. Before we get to Becky, though, let's run through a few quick headlines for you. It's 1 p.m. on Wall Street, and right now the Dow Jones Industrial Average is trading down about 40 points. The S&P 500 is off 3, and oil and gold all on the move as well today. The NASDAQ Composite, incidentally, is off about 9 points. The gold market rebounding a little bit, but oil has dropped below the $90 a barrel mark for the first time this year. There's the retail index hitting an all-time high today. It's up better than 4 points. And that comes despite a big jump in gasoline prices earlier this year and the end of that payroll tax holiday. Netflix is in that index, but it is down big today on the trading session. And Dollar Tree, Home Depot, and Target are also in that index. Now, we're also watching Google, which is now up $6.70, and that would put it at an all-time high. Ty?
Well, Sue, now on to the big story of the day here on CNBC. Even I got out of bed for the 6 a.m. hour of Squawk Box today because Becky Quick sat down with Warren Buffett for 3 hours of coverage on Squawk Box this morning. We turn it over to her now in La Vista, Nebraska, just outside of Omaha. Becky?
Tyler, thank you very much. As always, high on the list of questions for Warren Buffett today is how he's making money in this market and what his confidence level is right now. We talked broadly, we talked specifically, but we started by focusing in on Heinz. That's a company he just announced last month that he'd be acquiring.
Well, Heinz makes sense because we've got a business we like, and we've got a partner we like, and we've got a price that I barely like. But we've got a great business. And And that's the most important thing. Then we have these terrific partners, Georgie Paulo Lamont. I've known for a dozen years. You can't find better business people, and they will do the work. We are a financing partner, and we hope to own Heinz 100 years from now. I mean, if you own great brands and you take care of them, they're terrific assets.
What do you think of Bank of America? Does the stock still have room to run? You noticed that you picked that stock a couple years ago with the preferred that you got into.
Yeah, well, we have warrants that run for 9 years. We're gonna hold the warrants till the end of that period, 8.5 years, and we expect Bank of America in 8.5 years to be worth significantly more than it is now. I have no idea whether it's going to go up or down tomorrow, or next week, or next month, or next year, but. They are making progress in getting rid of a lot of things that they shouldn't have been in. They're making progress on cleaning up mortgage problems from the past, most of which came from their acquisition of Countrywide. They're doing the right things, and they've got a terrific low-cost deposit base. So over time, they will do well. But no one knows whether that stock is, in my view, knows whether it's going to go up, down, or sideways in the next 6 months. So we just don't try to do that sort of thing.
If you could give any advice to Tim Cook of Apple and its shareholders, what would it be? Should they give more in terms of a dividend? Should they split the stock? Is Apple now a long-term growth stock that you would consider purchasing at its current levels?
Yeah, I don't own any Apple stock, and I haven't. I did talk to Steve Jobs a few years ago about what they did with the cash, as we've talked about earlier. But the best thing you can do with a business is run it well. And if you run it well, the stock behaves fine over time. Berkshire has gone from $15 a share to $150,000. Now, there's been times when it's 4 times when it's gone down 50%, and there's been all kinds of times when people have criticized doing this thing or that thing. But basically, we've just focused on running the business. And if you run the business,
you've never had to deal with a hostile activist investor like David Einhorn, who's going out after Apple right now.
Well, I would ignore him. I would run the business in such a manner as to create the most value over the next 5 or 10 years. And you can't run a business to try and run the stock up every day.
But if you're looking at Apple, I mean, it has faced some massive fluctuations. Tech stocks tend to be a lot more volatile than some other stocks, including Berkshire shares.
Berkshire's gone down 50%, though, 4 times.
Wow.
Yeah, 4 times in its history it's gone down 50%.
And at that point, again, just focus on what you're doing?
If you've got money, you buy it, and you just keep working on building the value. But 4 times, and I heard from people at those times that said, why don't you do this or that, and usually pay a dividend. They think it might go up because of that. Would have gone down, actually. No, we just kept focusing on building value. And I think Apple's done a pretty good job of building value. They may have too much cash around. Now, one of the reasons they have that cash around is because 2/3 of it hasn't been taxed yet. Right. And they don't want to bring it in because they don't want to pay the tax. When Steve called me, it was a few years ago. I said, "Is your stock cheap?" And he said, "Yes." And I said, "Have you got more cash than you need?" He said, "A little bit." And I said, "Then you buy in your stock," but he didn't do it.
But okay, you just said what you told Steve Jobs a couple of years ago, and you just said yourself, when Berkshire went down, if you have cash, buy the stock. So you're basically suggesting a stock buyback.
If you don't have uses for the money in the business.
Mm-hmm. All right, let's talk about another stock. This is one of your big 4 investments, Coca-Cola. And Chris Kreller writes in, why do you not increase the Coke stake? The name is near eternity, and this company seems to be a never-ending cash cow. You own 9% of the shares outstanding?
Yeah, we own 400 million shares, and we haven't bought or sold any stock for 20 years. There are other things that I think are cheaper. We bought Wells Fargo this year. I think Wells Fargo is cheaper than Coke. I may be wrong. I think they're both wonderful companies. And then now I'm giving some money to the 2 other managers. In fact, I'll make news for you today. Last week I told them I was going to give another $1 billion each.
You're talking about Todd and Ted?
Todd and Ted. I'm giving them
Todd
on March 31st.
Ted Weschler.
Yeah. Yeah, they're making me look bad, so I'm going to give them another $1 billion so they don't talk about it.
One of the other changes you noted in the annual report was that of the stocks that you break out in the investment holdings, there was a new one added to the list. That was DirecTV.
Right.
And you only put stocks on this list that you have over $1 billion invested in. This is the first time that someone besides you has invested enough money to make it onto that list.
Right.
DirecTV was the biggie again, and that was because both Todd and Ted are putting money in this?
They both have put money in there. And I do not include the pension fund monies they manage, and there'd be another one on there if that was included. In fact, there would be more DirecTV because they had some of that in pensions too. They concentrate their investments just like I do. One of them has, I think, only 5 stocks. The other may have 11 or 12. And they don't check them with me ahead of time. I look at some reports at the end of the month, and so I know what they buy or sell. But we just make sure the things where we'd have to file a 13D or something, that we make sure that that's coordinated. But other than that, they have total carte blanche. They could put it all in one stock.
Was it just a coincidence that they both invested in DirecTV? They didn't check with each other first?
I think they're both smart. No, I don't think they check.
They don't balance it off each other.
No,
right?
no,
it just happened that way.
No. And as you know, a small part of their compensation is based on what the other fellow does.
Right.
So they've got every reason to be cooperative. But they do not. They work quite independently.
Okay, you tried to slip this through. You mentioned that there would be another stock that would have made the list of over $1 billion if you were looking at the pension fund money they run as well. What was that stock?
DaVita.
What? I'm sorry, what was it?
DaVita.
DaVita?
Yeah.
Wow. If you look at the S&P 500 right now, do you think that stocks are undervalued or overvalued?
Well, I think they're undervalued relative to other assets. In other words, if I had a lot of money today, I would rather own equities than own fixed dollars, long-term government bonds, junk bonds, farmland, REITs. They will be affected if interest rates go up dramatically. All assets will go down in value because interest rates to investments are like gravity is, basically the physics. I mean, everything goes off of interest rates. But the cheapest thing around, I wrote that a year ago. I've been writing it for year after year. They're not as cheap as they were 4 years ago, but you get more for your money. And that's why we like buying businesses and we like buying stocks. You get more for your money there than you will get. The one thing that the dumbest investment, in my view, is a long-term government bond. I think a single-family house is a good investment for people where it fits their living pattern and what they're going to do. I think that makes it, and you can finance it extraordinarily favorably, and I think that makes sense for people.
Let's get to Becky, who is in Omaha this morning. She's with Berkshire Hathaway Chairman and CEO Warren Buffett. Becky, I was I don't know what, leading into the last break, I was thinking about, I don't know whether you saw Barron's, there's a Jeremy Grantham piece that was very troubling to me, and I wanted to just at some point ask Warren about.
Why don't you ask him now?
Yeah, okay. Warren, his basic thrust was that our middle class has been getting more and more decimated over the years as a lot of the cheap labor is found in the rest of the world, where obviously the standard of living is not as high, and it's just been a natural progression to send a lot of the jobs overseas. As a result, the middle class has had to borrow to fund a lifestyle, and that's one of the reasons that the consumer is so strapped at this point. And it's a very negative piece where basically looking for another 7 years or so of subpar growth because of this. And I don't know what the answer is. I think re-education or more to try to become more competitive or at least better than the rest of the world at doing things for our labor force. You have an answer for that?
Yeah, the answer is, our market system has worked well for 200 plus years. It's working well now in all areas except home construction, those related to home construction. We're sitting here with a market that's doubled from 3 years ago when we were sitting here. This country is remarkable. I mean, you have people in our own company. You've got Tony Nicely at Geico trying to figure out how to serve customers better tomorrow, how to bring down costs. You've got Matt Rose trying to plan for the future of railroads in Fort Worth today and tomorrow. You've got people at Apple trying to come up with new products that you and I haven't thought of yet. American capitalism is dynamic, so anytime you look at it on a static basis, you can get very pessimistic. And when I got out of school in 1951, the two people I revered most in the world, my dad and Ben Graham, told me it was a bad time to start in business. You can sit down at the start of every year and write down 10 or 20 reasons why things are terrible. But the truth is this economy works wonderfully. It's working wonderfully now. I mean, it isn't working for everybody at this moment, and it's coming back from a terrible shock that it received in the fall of 2008. But look how far it's come back, and it continues to come back every day. It's been doing it now since the fall of 2009. So it's, you know, it is a terrible mistake to get pessimistic on America. You know, it has not worked since 1776, and it's not going to start working now.
Warren, we touched on this in the last hour, but just the idea, you bring up that the stock market has doubled over the last 3 years when we've been sitting here. And again, there are many people who now worry that the best and easiest gains are over. You said yourself in the last hour that it's not springtime anymore. No. Does that change the way that people should be looking at the stock market as a potential investment?
They should be looking at the funds they're going to save. I mean, those are the only funds you invest with, and figure out what's the best thing to do with them. And they can buy farmland, they can buy apartment houses, they can buy duplexes, they can buy businesses, they can buy businesses through stocks, they can buy rare stamps, they can buy gold, or they can stick it in money market accounts and all. They've always got all those options. And I've written a section in the annual report why I think that businesses are the best option. Now, the nice thing about businesses in this country is you can buy into all the best businesses in the United States virtually. You can buy a piece of them, and you don't have to buy, you know, if you don't understand company XYZ, you can buy company ABC. And naturally, it'd be nicer to buy them at the prices of 3 years ago. But you know, they are attractive relative to other assets. That doesn't mean they're going to go up. But I will guarantee you that over a 20 or 30-year period, they're going to perform very well. And as I mentioned a little earlier, actually single-family houses bought on a distressed basis now and financed over a long term at these interest rates may be the best investment of all. I mean, if I knew anything about real estate and I just was working with a relatively small amount of money and I was seeing distressed houses around me that I could rent out, I would buy them and put on a 4% mortgage for 30 years, and you know, in 3 or 4 or 5 years, I'd probably sell it at a very substantial profit relative to my equity.
Okay. You know, Warren, we left off in the last break talking about taxes, and your role in this tax debate has become very central and very polarizing. And just last week, Governor Chris Christie of New Jersey weighed in on this and weighed in on what you've been saying. Take a listen to what he had to say.
Warren Buffett keeps screaming to be taxed more.
Yeah, well, he should just write a check and shut up. Really, and just contribute, okay? I mean, you know, the fact of the matter is that I'm tired of hearing about it. If he wants to give the government more money, he's got the ability to write a check. Go ahead and write it.
He's not the only person who feels that way. We've got a lot of your email that came in. We've been sitting down and doing this Ask Warren session here for, I guess, the last 4 years or so. And this year, more than any other year, there were a lot of emails that came in that similarly echoed what Chris Christie had to say.
Well, I hope they're a little more eloquent than that. But you know, it's sort of a touching response to a $1.2 trillion deficit, isn't it? That somehow the American people will just all send in checks and take care of it. That was first fellow to come up with that was Senator McConnell, and I really. It's sort of astounding to me that somebody that has the responsibility for being the minority leader in the Senate would think that you attack a $1.2 trillion or so deficit by asking for voluntary contributions. Since he did, I offered to triple his, but that's a sideshow. The real problem we have is we're taking in too little money and we're spending too much, and that's not going to be solved by voluntary contributions. What we need is a policy, a tax policy, and to give you an idea of how extreme it is, just take a look at what I've labeled A1, and you can find this on the internet. And the figures I've circled in 1992 showed that the 400 largest incomes in the United States that year, adjusted gross incomes, were $18 billion. Now that's about $45 million a person. And if you go down to 2008, it's $108 billion. That's $270 million a person. So from 1992, the 400 top incomes went from $45 million to $270 million, which is not bad, I think. Now, if you go over to A2, you will see that during the same period, those top 400 saw their tax rates drop from 26.3% to 18.1%. At the same time that was happening. But what's even more startling is if you go to A3, and you will see that in 1992, 6 people among those 400 paid at a rate that was less than 10%. That's just 2/3 of what the average person pays on payroll taxes. And that 6 went up to 30 over that period, and the number paying from 10 to 15 went from 10 to 101. So 131 of the 400 largest incomes, averaging $270 million each, 131 out of 400 were paying at a 15% rate or below. And that, the payroll tax for people making less than 100,000 up until this year was 15.3% they were paying. So solving that problem, solving the problem of me paying the low tax rate I pay, is not going to solve the fiscal problems of the United States. But to ask other people to be making sacrifices during this period, and we're going to ask them to make sacrifices. We're going to ask them to make it on the revenue side and on the expenditure side. And to leave this group alone is a travesty.
So to Joe's point, you can't fix the deficit by just going after.
No, you can't. You can't fix the deficit by going after any one expenditure or any one revenue item, and you certainly can't fix it by asking for voluntary contributions.
So this is something that you think for the optics of the situation, or just for the appearance of fairness, the president says all the time?
I think it should be incorporated into a revision of which is going to happen on both the revenue side and the expenditure side. But I certainly think it's important to incorporate this into a revision. And I think this is something that can be done immediately. I mean, a minimum tax on people. There's 131 people that filed those returns that showed 15% or less, and my cleaning lady Mary, has a payroll tax of 15%.
Joe?
But I just don't know. I don't know why you harp on it so much, Warren, when you know that it's 1%. It's not going to do it. It wouldn't solve anything, and maybe we need to fix it for the optics of the situation. But what I guess the real question is, what do we do with dividend income and capital gains income? Because let's say that you work your entire life paying ordinary income, and you're not. Let's say you're not getting carried interest. Let's say you under your normal situation, you're paying ordinary income at 30 or 35%, and you do very well, and you're very successful. And at that point in your life, you're 60 years old, 65 years old. You invest in dividend-paying stocks, and you have capital gains, which lowers your taxes to that rate. You've paid taxes once already. I mean, we need to decide what the correct rate for capital formation is for long-term gains and for dividend income. It just seems, I don't know, just to keep bringing it up as a red herring. Look at this. It's not fair. It's not fair when you know it has to do with long-term gains and dividend income. Let's do something. Let's find the right rates for dividend income and long-term gains, and stop pointing fingers at these people.
Well, I don't think I've named an individual.
No, you haven't. But it's a matter of public record. You only got to look up 130 of them.
No, but the real question is this a tax code the United States should be proud of that produces these results?
I don't know whether we should be, but now we're back to emotion again. We're proud, we're not fair, we're not this. We got a huge problem, and this won't scratch the surface of the problem. And carried interest, carried interest, you need to do something with carried interest as well. And maybe if there's an optics there, but the real problem, and the reason Simpson-Bowles is so hard, is that most people don't want their entitlements to be touched for Medicare or for Social Security, and that's going to be the hardest thing that we try to do in dealing with the deficit. Not taxing 131 people that makes you feel better about yourself.
Well, no, the numbers here, though, just think about it a second, Joe. The numbers here probably come to $40 billion. Now, that may not sound like a lot of money to you, but $40 billion is almost $2,000 a piece for 20 million families. If you take the bottom 20% in the United States, there's almost 24 million households, and their top income is $21,000. Now, to those people, 40 billion divided by their 20-some million is real money. It's $1,000 or $2,000. But I don't argue with you. It's going to be tough to take away promises we've made. We're a rich family that's overpromised. But to not start at the top. I mean, this is something we can do something about right now.
But how do we do it, Warren?
It's not
shouldn't we try to figure out what the best rate for the most competitive and the rate that brings everyone the most benefit in dividends and capital? We got to have that discussion. Isn't that more important? Because that's how these people are. To just like put a like a surtax or something or we could do that. I've asked you, why can't we just tax you at 10% of your wealth? And that didn't go over very well with you either. 10% of all this wealth would bring in quite a bit of money too. I figure we get about $5 billion from you alone, right?
Yeah, that's true. And actually, wealth tax is tough to enforce. I mean, it's very hard to say what every farm is worth, or every private business is worth. I don't particularly favor a wealth tax, but I would have no objection to it. I mean, if 10% of my wealth and 10% of everybody's wealth went to the government, I don't think that's the best system. But,
what should we do with capital gain? What do you think? You think is 30% okay? What about dividends? They're already taxed the first time when a company is in its operation. Well, I guess you'd say it's taxed at 1.2% anyway for corporations, but they do pay taxes once. What should the dividend rate be? I mean, you must have an idea where capital gains and dividends should be right now, tax rates.
Yeah, well, incidentally, that point about double taxation has been made, but I just thought it would be fun to take a look at my own situation, because if you go back to, I made these calculations in the office 3 times where my rate was about half of everybody else's rate, and if you go back to 2004. If you put up, what would be that number on that? Put up,
Warren, let me ask you, what do you think about dividends? Is there a rate that is acceptable if they went to 25%, if they went to 30%?
The best period we had in post-war history, the 50s and 60s. Mm-hmm. And in the 50s and 60s, the tax rate generally on capital gains was 25%. Mm-hmm. And the tax rate on ordinary income got up to 80% or thereabouts. And our country prospered very substantially. I mean, the stock market did well, investors did well, the economy did well. So that was a rate that worked very well. The corporate tax rates then were 52%. And people paid them, incidentally.
Should capital gains and dividends be the same rate as ordinary income?
That depends on what the ordinary income rates are. I mean, you can go that either way. That's what they were in 1986. I mean, that was under Reagan, we went to 28% on everything. I don't have any problem with that. I think that says every tax system is going to get criticized, but I would not have a problem with a 28% rate. There'd be a lower rate on people with lower incomes, but so it would still be a graduated rate. But the idea of taxing capital gains and dividends at the same rate, we've done that in 1986, and people thought it was a wonderful improvement on the tax code at that time.
Mm-hmm. Joe, does that answer your question?
Yeah, I think now, or at least now we're having the discussion. Maybe that's what we need to do, and then we need to just. You'll hear from certain people that just say, for competitive reasons, you don't want to raise taxes on the job creators, blah blah. You've heard all this stuff before, but at least we can then have an actual discussion, because that would take care of this whole issue that your secretary pays less than you in tax. That wouldn't happen if your income was taxed at ordinary income rates. That we'd be finished with the discussion if it was 28%, Warren.
Yeah, no, she wasn't paying. Well, you've got to integrate payroll taxes in there too. But, I know. Yeah.
Well, and you must be. I mean, it'd be nice if you give her a little bit of a raise, then we wouldn't have to worry about it all the time. You could probably pay her $500,000 a year, right? She does. I mean, dealing with you must be worth at least $500,000.
Her tax rate, yeah, well, it is. There's no question. She's worth it, but her tax rate then would not. It would still be double mine. It doesn't. Well,
that's because yours is all on. That's because yours is all dividend income. You don't pay yourself any ordinary income. I wouldn't pay myself anything if I were you either, but I sure would like $60 billion.
Yeah, well, 131 out of those 400 people came in at below 15%.
I know. They got dividend. Okay, now we're going in circles. We're back to we got to figure out how to do that. And then the carried interest thing, which is also you know, when you say someone has worked a lifetime and then is enjoying the fruits of their lower tax rates, if you made your entire income from the carried interest, then you got to, then you got to explain that away. That makes it tough. That optically is bad.
Joe, we had this fellow Todd Combs. He came to work for us last year. He was running a hedge fund before that. He made a lot of money from us last year because his performance was terrific. He did exactly what he was doing at the hedge fund before. He had people working for him. He came to work at the same time, read the same papers, and he got taxed at more than twice the rate that he would have if he'd done exactly the same activities at a hedge fund. Now, that does not strike me as making any sense.
Welcome back, everybody. We've been speaking with Warren Buffett all morning long. And Warren, one of the things we haven't talked about yet is another one of your major holdings. I think Procter & Gamble is maybe your 5th largest holding.
It could be.
There was a story yesterday in the Wall Street Journal that took a look at Bob McDonald, the CEO. There have been a lot of questions in the past raised by Bill Ackman, an investor who's put quite a bit of money into it, about whether or not Bob McDonald's up to the job. Yesterday, the Journal added that there was a letter sent to the board of directors that came from a former manager who said a lot of managers agreed with him about some of his concerns about Bob McDonald's leadership. So where do you stand as an investor in Procter & Gamble, and what do you think of Bob McDonald?
Well, we owned more shares in the past, but we sold some shares under A.G. Lafley. We sold some shares. That's related to valuation, and frankly, the earnings on Procter & Gamble have been disappointing now for a few years. McDonald is a terrific human being. What goes on inside the place, what mistakes have been made, what the plans are, I'm really not, I don't know the answers on that. But you've got to say that Procter & Gamble is, the jury's out on that now because they have disappointed in terms of earnings, and we'll see what happens. I know that the board is actively engaged in trying to come up with a strategy that they think makes sense to take the earnings forward.
In the past, you've said that when you sell a stock, it's because you find something else that is a better investment, a better place to put your money. Did you sell that stock for any other particular purchase, or was it just?
Yeah, no, we've sold that. We've sold crap. We sold some companies that are very, very good companies, and we've used that money. We used it to buy what? $11 or $12 billion worth of IBM in the last 12 months. We bought more Wells, another $1 billion worth of that. And then we bought some more Walmart a while back, another $700 or $800 million of that. And then additionally, I've given some money to these 2 new managers to run too. So you'll see a lot of stocks that they selected. So the money moves around pretty slowly, but it moves around.
Todd and Ted, we can maybe talk more about them in just a little bit. Those are the 2 managers you were just referring to.
And I'm giving them more money as we go along.
Okay, we'll talk more about that in just a moment. Warren, we just heard the ADP numbers here, and obviously they were a little stronger than had been expected. Everybody's playing this guessing game right now, though, trying to figure out where the economy stands. And that brings us back to a discussion we had earlier this morning, trying to figure out what the Fed does next with its monetary policy. You said if you were Ben Bernanke, you'd end QE2 right now based on how you think the economy's doing.
I think the economy is coming back, and I think that we'll never know. There's probably 3 big variables in the economy's development, and we like to think of monetary policy and fiscal policy because we all learn about them in school and all that. I think the most important factor by far is just this underlying regenerative capacity of capitalism. I mean, if you go back a century or so, nobody had ever heard of monetary policy or fiscal policy, and we had recessions, and they cured themselves. And they cured themselves because millions of Americans were trying to figure out how to do things better the next day. I mean, capitalism works. And I think in this particular recession, I think it was enormously important what the Fed and the Treasury and government did immediately. They had to end a panic. But I think if you talk about what's happened in the last year, I think that who knows the importance of the variables of fiscal and monetary policy. If you ask me, they're number 2 and 3 compared to this natural regenerative capacity. And we've had foot to the floor, as I've said, on monetary policy. We've had foot to the floor on fiscal policy. But I think what's really getting the job done is the imagination, creativity, the energy of the American public in terms of keeping a system going that's worked marvelously for several hundred years.
Hey, Joe, you have a question, too?
Yeah, I got a specific one, shifting gears a little bit. Warren, you love Wells Fargo. You talk about it a lot. You were in, Berkshire was in Bank of America. and it wasn't a good experience. And you're out now. I think you lost 2/3 or something. But I mean, obviously the financial crisis hit, but that's making you're voting with your feet there, I think, on management, or on the prospects for B of A. I mean, you're staying in another bank. Why would you get out with a loss instead of go ahead.
I never bought a share of Bank of America. That was one of the 15 or so positions of Lou Simpson. So he did not make a decision to sell Bank of America in the second half of last year. He was liquidating his entire portfolio. He sold Nike. He hated to sell Nike. He loved Nike, but he was cleaning out his portfolio, and Todd's bringing in a new one. But Bank of America was never part of a portfolio I managed.
So when you see Berkshire liquidates its entire stake in Bank of America, you can't say, oh my God, they don't like the prospects, or Warren doesn't like the prospects for Merrill Lynch or Moynihan, or you can't draw any conclusions from that.
No.
Okay.
Zero. I never bought a share, and I never sold a share personally.
Okay.
We're going to talk about a lot of things this morning, but obviously with so much of the global market turmoil, there couldn't be a better day to be joined for 3 hours by the world's most successful investor. Warren Buffett is here. Got up extra early with us because, of course, out here it's only 5 a.m. Warren, thanks for getting up early, first of all.
We got to start this earlier.
You saw what happened overnight based on the elections in Europe over the weekend. What do you think about what's happening right now with the global market sell-off?
Well, it really doesn't make any difference to us. We were buying stocks on Friday, and we'll buy the same stocks today, and we'll buy them a little cheaper. So I never complain about buying things cheaper.
You were buying stocks on Friday. You said stocks multiple. This is not just one issue that you're into?
Well, just two.
You have two stocks that you're buying?
Yeah.
Are these U.S. stocks?
Yes.
Are these...
I think you've exhausted your...
what I'm going to get out of you on this, but you had two stocks that you were buying. Are these issues you've been looking at for a long time?
It's issues we already own.
Okay, so you're adding to your positions, and you'll buy more today based on this sell-off?
Yeah, the lower they go, the more we like it.
Obviously, though, what's happening right now in Europe is something that people have been looking at for a long time. You've been worried about the euro for a long time as a result. And when you see the shift away from austerity and the pushback that's coming from the voters, what do you think it means for the future of Europe?
It's going to be very, very difficult to resolve their problems. I mean, not only are there problems of having 17 countries, but you've got problems of getting the constituencies in those countries behind and coordinating in some way. So it's a really tough problem.
Did you anticipate, just kind of as you thought things through, that the voters might swing this direction over time?
No, it's not surprising. I mean, if you tell people to tighten their belts and then you give them a chance to vote on it, it's the real problem of dealing with 17 countries, though, because even if you manage to sell to people in 1 or 2 or 3 countries on the fact that it's an advisable course of action, you really need 17 going in the same general direction. And if you're going to have a common monetary unit, you have to have somewhat common fiscal policies as you go along, and it's difficult.
So right now we see what's happening, and we get the fact that this is a bit of a sell-off. This is some trouble that comes along the way. I know it's really difficult to predict what happens, but if you look a little farther, if you try and look 2-3 years down the road, where do you think we wind up with Europe?
Well, I really don't know the answer, but there's going to be there'll be a lot more episodes. On the other hand, 10 or 20 years from now, Europe will be producing more goods per capita. I mean, Europe is not going to go away. It's a huge market. People have lots of skills. You've got factories. You've got wonderful companies over there. So it isn't like it's the end of the world, but it can be one very messy process in getting from here to there. We will get to there.
What does it do in relationship to the United States? We talked to a lot of people this weekend, including Bill Gates, who pointed out that the United States has not fixed its deficits or its problems. You know, you look at the euro, and it's now at a 3-month low. I think it was dropping and testing that 130 mark earlier this morning. Right. The United States looks like a stronger place. At least the treasuries have been a little safer. But how long can that continue?
I think it can continue a long time. The United States is on a different path, and we addressed the problems of our banks 3 years ago very decisively, and we put lots of capital in them, and they've retained lots of capital, and they've cleaned out a significant percentage of their bad loans. So we have a whole different banking system in the United States. Plus, we have our own currency, and being able to issue all of your debt in your own currency is just an entirely different game than having to issue it in some other currency.
The ECB has figured out a way to extend its balance sheet, though, with the LTRO. Do you expect more fiscal easing or more monetary easing policy to come from them?
Well, $1 trillion euros isn't bad. I mean, they really had a funding scare, whatever it was, 5 or 6 months ago, and the banks they're in weak capital positions in many cases. In many cases they're loaded with sovereign bonds that mark to market don't make them look very good, and so they had a big funding problem coming up, and the ECB stepped in, and they stepped in a very major way, and they stepped in with 3-year paper. So you have to congratulate the ECB on heading off that particular kind of a funding crisis, but. The problems haven't been solved with the banks over there. The liquidity problems have been solved, the funding problems, but they need more capital, and they've been very reluctant to raise capital. I mean, you have not seen the banks over there go out and raise capital. You had one in Italy that did it, but they've got a lot of problems. I want to emphasize they'll solve them, right. But not necessarily without a lot of pain.
Well, and that's where the politics get awfully ugly. In Greece, for this election over the weekend, you actually saw 20 neo-Nazi candidates who came into power. That's the first time that's happened since 1974, when the military dictatorship fell there. And I guess you've seen a lot of things like this before. Does this worry you as you start to see this turn politically?
There are always a lot of things that worry me in the world, but I also believe that they get resolved. But asking people to vote for pain, is not necessarily a winning political slogan. We're not going to have 2 candidates in this country that are going to ask people to vote for pain, and it can be done under certain circumstances. I mean, and obviously in a time like World War II, people really voted to restrict their own consumption and activities and all kinds of things. But it's not an easy job, and it's particularly not an easy job to get a number of countries to do it. And they always point at the other guy and say he's getting a better deal than we are, and that sort of thing.
I know Joe and Andrew have some questions from back in the studio too, guys.
Questions and comments, I guess.
That's a surprise, Joe.
Yeah. It's just, I guess, the whole structure of the EU and the common currency without the fiscal coordination. I guess I didn't think it through enough to see how it's actually going to work when this happens. You're really talking about the southern countries that have sort of lived beyond their means, saying, no, I won't accept us, even though we're broke. I won't accept austerity, and I want Germany to keep funding my lifestyle. And you're expecting the Germans who have, they had their own trouble when they had to bring in, the Eastern Europe, and they went through a lot of austerity themselves, and they've worked hard, and they finally get their day in the sun where things are going well, and you've got an entire southern region asking them to fund their lifestyle. What would normally happen, Warren, I think, is that you can't get people to accept austerity, so you devalue your currency, and de facto their buying power goes down, and they sort of have to accept it because that's the way it works. And then you have better exports and and without being able to do that, I don't see how this finally works. But I don't see, when France goes 90-90-90, we're going to elect a socialist and not accept austerity, and we want Germany to keep paying for everything. I'm watching it happen, and I'm trying to think of what we could, how it would work here. I know that we've got some poor states that the federal government, has to subsidize more than some of the other states, but we just don't feel that way here in this country. They have not accomplished the United States of Europe, and they're nowhere near there.
Well, you should have told them that 15 years ago, Joe, because you've given an analysis of the problem, and they do not have an answer for you.
I really, and we talked beforehand, Andrew said he's been worried about it for a while. But short of this just not working and just sort of accepting defeat, I don't know how this really looks. I don't see how. I don't know what the next step is in terms of whether someone. Don't you think it's time for Greece maybe to exit the euro?
Someone might have to ultimately exit the euro.
Well, everybody might have to ultimately exit.
But look, that's what I've been saying. I said the second you get Holland in there, the relationship with Merkel, it's going to be very, very difficult. My question for you, Warren, this morning is there any company that you've been keeping an eye on in Europe or anything in Europe that you would actually invest in today, given what's happening?
Well, we bought outright a Dutch company late last week. So, Europe isn't going away, but everything that Joe said is 100% correct, and no one knows the answer to the points that he laid out. But that doesn't stop us from buying a good business over there. If I got a call today on some major company in Europe that I understood and that I knew had good products and a good future, we'd buy it. Now, we take into account what's going on over there, but we'd buy it.
What would happen, though? Go ahead, Andrew.
I'd just be embarrassed if I were the French. It'd be like going back to my parents again and again and again and asking for more. Eventually, my pride would stop me from, the proud French. But they can't live the way they've been living, and yet they're still straight face going back to the Germans and say we're not going to cut, we're going to continue, because there's not enough millionaires. Are there, Warren, to tax at 75% to pay for the 56% of GDP that goes for the government? There's not enough people there to do that.
But Joe, if you were an impecunious nephew and you had a rich uncle and he doled some things out to you before, I'm not sure you'd be too embarrassed to go back to him.
Warren, we had a 2.2% GDP too, which was slowing, and for whatever reason. And then we had the employment report where I think over the weekend it looked more negative to me. The more I read, the more negative it looked as people gave up on looking for things. There's no way that what's happening over there can possibly be seen as anything but a negative for our numbers. Or maybe it doesn't take a material amount off of GDP, but it's certainly not going to add to GDP by force here, will it?
Well, I think you're probably right on that, but we don't buy stocks or businesses based on the outlook for the next 3 months or 6 months. I bought my first stock in the spring of 1942. When I was 11 years old, and at that point we were losing the War of the Pacific to the Japanese, and I mean, if you'd read the headlines every day, it'd be kind of fun to go back and look at the headlines on the day I bought my first stock, because things were looking terrible until the Battle of Midway, and I bought in a few months before that. So I think it's a terrible mistake. I think the worst mistake you can make in stocks is to buy or sell based on current headlines.
Hey Warren, in the great debate between austerity and stimulus, and it may be almost unfair to frame it that way because we probably need a combination of both. How do you think about this issue when you look at what's happening in Europe and you look at this debate, which, by the way, is a debate that's happening here?
Yeah, I think actually, nobody knows because you can't run controlled experiments. But actually, I think we've handled it pretty well here, and much better, I might say, than the Europeans. But we've had an easier way to handle it than the Europeans. So if we'd had their structure, who knows what would happen? But because we've had a structure where if the Fed and the Treasury and the government basically said we've got the will and the ability to give this country a jolt on the way back, we can follow the policies we set out to follow. And we have had stimulus from the word go in the fall of 2008. We only called that particular bill. In fact, we didn't even call that a stimulus bill because the term got unpopular. But we've had continuous stimulus. Anytime you're spending 7 or 8 or 9% more of GDP than you're taking in as a government, that is huge stimulus by any Keynesian definition. I don't care whether you call it stimulus or you call it anti-stimulus. It's stimulus when the government is spending way more than it's taking in. And we have stimulus right till today. I mean, we are running at whatever it may be, 8% of GDP as a deficit. And Keynes is probably cheering up in heaven.
Yeah, but the other side is saying it's too much.
We're going to have the argument about it. We'll have a lot of argument about it between now and Election Day. But I would say overall that the policies we've followed since really the great crash of 2008 have been pretty darn good. I mean, it'd be nicer if GDP were galloping maybe at 4% or 5%, but we have had completely a resuscitation of the viability of the banking system. We've had, all cases except residential construction, we have had the economy come back in a very significant way, and month by month it gets better, and we've got all these businesses. And again, with the exception of residential construction, most of them are having record earnings. The big ones are all having record earnings. We're employing more people, but not at any galloping pace.
Warren Buffett, who's been kind enough to be with us for the past, hour and 45 minutes or so. Warren, we look at Europe all the time, and you've talked to us in the past about the Eurozone crisis and what you see happening. You already talked a little bit about the European banks, that you think that they're in a very different position than the American banks. But last week, Francois Hollande suggested that the Eurozone is well on its way past this crisis, is really moving out the other side of things. Is that the impression that you get?
No, I wouldn't say so. I mean, I don't know how it plays out, but I certainly don't feel that it's clear that it's on the road to recovery. I mean, they have a real banking problem. I mean, they to some extent encourage their banks to load up with sovereign debt. So you have the sovereigns counting on the banks and the banks counting on the sovereigns, and that can create a problem. And it's going to be a very tough thing to have austerity and at the same time grow GDP. It's not an easy solution. Europe isn't going to go away. I mean, we'll be doing lots of business there 5 or 10 years from now, but I think it could be pretty rough there for a while.
Is that a good argument for pulling back from the area, or is this a time you think businesses should
they either have to come closer together, or I mean, they're going to go one direction or the other. But the idea of having a monetary union independent of really discipline on the fiscal side, although they said they had it originally, they've got to come closer together, or it won't be sustainable.
Although the ECB has made some major moves to try and reassure the markets, and that certainly has given them quite a bit more time.
Yeah, well, central banks can print money. It's a wonderful machine to have. In economics, just like in life generally, you never can do just one thing. I mean, anything you say you're going to do is going to have consequences, and sometimes those consequences are delayed. Certainly printing money has consequences, and you can say not printing money would have consequences in the United States too, but we haven't seen the movie's not over in Europe.
Joe, you have a question too?
Warren, do you still think a single-family home is one of the best investments around? And have you actually tried to figure out a way to invest in that? You'd like to buy 100,000. You said you'd like to just buy as many as you could, but they're impossible to manage, and you can't really do it. Have you tried to figure out a way to do it?
Yeah, and I've had a lot of suggestions from people after I made that statement, but it's not really feasible. And certainly compared to other things we can do with money, it's just too big a problem to deal with small units like that, and management problems and human problems. So I think that anybody that knows where they're going to want to live, has a reasonably assured income, I think they're making a terrible mistake if they don't buy a single-family home now and get a mortgage at these rates, and they should get a 30-year mortgage. It's really a golden opportunity. It was a little bit better 6 months ago, but it's still wonderful now. You're not going to see a chance like this 5 years from now. I'll guarantee you that. And 5
years from now, it's going to be a different picture, and that's.
And rates will be higher and all kinds of things. I mean, this is the time to buy. If you know where you want, you got to want to live there. I mean, and a home's a wonderful thing, but I wouldn't buy one if I was going to move in 6 months or something of the sort. And I wouldn't buy one if I was terribly nervous about my job.
Warren, a couple of times you have mentioned Ted and Todd, Ted Weschler, Todd Combs, talked about what they've been doing as an investment cycle. A lot of times we get these notes from the SEC just about what Berkshire's doing with its investments. How much of that is yours? How much of it is theirs?
Very little of it's mine. I mean, if it's Wells Fargo or IBM or Coca-Cola, I mean, I've got 4 stocks that are aggregate over $50 billion that I manage, and I've got a bunch of other things too. But the action is with Ted and Todd, and they're building up portfolios, and they will buy $500 million at a time of something, and they're probably more prone. One of the two is more prone to move around in securities than I would be. But there's a lot of styles that work. So I am enormously pleased. They're getting lots of contingent compensation, less than they would if they were running a hedge fund, and they're paying a higher tax rate than if they were running a hedge fund, even though they're doing exactly what they would be doing if they ran a hedge fund. It's a real indictment of the tax system when you look at two guys who've just moved to doing the same exact thing from morning to night they did before, and now they pay double the tax rate for it, more than double.
That's a good point. Andrew?
Hey, Warren, I wanted to get an update on my favorite subject, newspapers. You bought the Omaha World Herald earlier this year. You now had a little bit of time to get under the hood. What do you think?
Well, I'll have a big section in the annual report about newspapers, and I did write a letter to all our newspaper publishers. If you have a newspaper that's indispensable to a significant percentage of its community, I think you're going to do reasonably well over time. We still pay very, very low multiples for them. The trend of the newspaper industry is down, but you have to be primary about things that are of interest to your readers. And if they're, if you're in Grand Island, Nebraska, where we have a product, we've got to be relevant to what the people in Grand Island are interested in, and that's a much tougher problem as you get into bigger metropolitan papers.
But it's working better or worse than you expected. I only say it because Newsweek just said they were going to stop printing recently. And I know community newspapers are a different situation, but a lot of people always have questions.
Yeah, our small newspapers, and by that I mean towns of 20,000, 25,000, our small newspapers this year that have operated throughout the entire year for us, the revenues are down about 1%. Our larger newspapers like Buffalo and Omaha and now Richmond, those papers, which are larger communities, their revenues on average would be down more like 4 or 5%. So there is a real difference based on the relevance of the paper to a very very significant portion of its community. The bigger the community, the harder it is to have a community feeling.
Warren, very quickly, earlier this week was the release of Greg Smith's book about Goldman Sachs, the guy who wrote that op-ed piece in the New York Times saying, "This is why I left Goldman Sachs." Did you see any of the interviews that he has done? Did you take a look at any of the book? What do you?
I haven't read the book. I saw an interview, but I think the idea of a guy 33 who's making $500,000 a year and is unhappy because he isn't making $1 million, and probably in any other occupation but investment banking would be making $75,000 a year. I thought the idea that one disgruntled employee leaving a company with 30,000 employees warrants an op-ed with no specifics really in it except the word Buffett's. I think I did not think that reflected great editorial judgment.
Okay. I bring this up because Lloyd Blankfein's going to be on a little later in the morning. Warren, obviously we've covered a lot of ground, and we appreciate you for spending so much time with us and talking so much. Warren, first of all, Sylvia Matthews Burwell, who's being nominated for OMB, she's from the Walmart Foundation, but you have some experience with her as well. You know who she is?
Yeah, I think she was the Gates Foundation, too, and after she left, working with Bob Rubin. And no, she's first class.
Okay, so just again, it's amazing, Joe, as you sit here, Buffett has thoughts or knows just about someone involved in just about every one of the headlines that you ran through. You spoke about Janet Yellen, and Warren, we've spoken an awful lot about your thoughts on the economy this morning. Yellen is just making this speech, probably not a surprise to hear many of the things that she's saying, that she doesn't see any cost right now to what the Fed's doing. Do you worry about future costs?
Well, there's never a problem when you're buying. I mean, the Hunt brothers were doing great on silver, while they were buying. It's the selling that could be a problem, to whom. And it's got to be some kind of a problem when they unwind. Now, how big a problem, I don't know. But you do know that throughout the world, decisions are being made on the basis that money is basically free. And when the signal comes that that's going to change in a major way, you're going to see a lot of activity, a lot of places, and how extreme it gets, I don't know. It doesn't have anything to do with what we do. I mean, if we buy Heinz, we know that's coming at some point. We're buying Heinz owner at 100 years. So, but this will be the biggest. This will be the biggest economic event for market participants that they have seen in quite a while, when they get a strong signal that the Fed is reversing in a significant way.
You've made it very clear that you are a fan of Ben Bernanke. You think
Terrific.
that he saved the global financial system
Absolutely.
back in 2008. But you've also been saying, I think for over a year at this point, that you've been concerned about how much the Fed is doing. Are you growing increasingly concerned? Another $85 billion every month just in QE infinity.
It's easy to do on the upside. And like I say, you could. We're having 3.6 billion of expenditures, trillion, and let's just say he bought the whole issue, and we had no taxes. Well, we know that doesn't work over time, right? But the Fed could do it. They could buy 3.6 trillion, and they could set up deposits for banks and so on. That would have enormous problems. We're doing a small variation of that, not so small, at 1 trillion, and it's an act that Bernanke has said he doesn't want to carry the whole load himself. I think the guy has been just absolutely terrific as the Fed chairman. But I don't think and I'm sure he's thought a lot about how he unwinds this and all of that. But I don't think it's totally predictable what will happen when it does happen.
Let's talk about the euro very quickly. It has come under some pressure recently. People, including members of the ECB, have told us on Squawk Box that they are concerned about what's happening in Italy. This fellow Grillo, who won 25% of the election there, has said that he'd like to see a vote from the Italian voters whether or not they want to still be in the euro. Yeah. Where do you think we stand with the euro, which is right at 130 right now versus the dollar?
We still haven't worked out a sustainable system for the euro. We have stemmed the fear when Draghi said that he would do whatever it takes. Whenever a central banker who can print money says, I'll do whatever it takes, that's very reassuring, but it doesn't solve the problem. I mean, the inconsistency of the fiscal policies of people who are trying to hook themselves to a common monetary unit has to be solved in some form, and we haven't gotten there yet. On the other hand, Europe is not going down the drain or anything. Europe 10 years from now will be producing more goods than it is today. But there's a lot to work through. Draghi headed off the immediate problem when he said, I'll do whatever it takes.
All right, let's get to some questions real quickly. One from, or actually, go ahead, Joe. Why don't we let you ask this question?
It's great to go to viewer questions. I had a huge philosophical question for Warren and how it's going to work its way out, because just seeing what we've been through for the past couple of months with the prospect of the sequester, and I don't know how we should do it, Warren, but you look at the deficits we're running $1 trillion, and you see how hard it was just to raise taxes, as we did at the end of the year, and then to do the $85 billion, which this year isn't even going to be $85 billion. And I just wonder whether we're going to get to the point where we decide we want this much government and we just need to pay for it, and that means rich people don't have enough, so we'd have to raise taxes on the middle class, I guess. I mean, do you see a way out of it, as hard as it was just to cut $85 billion? We got another $900 billion a year that we somehow have to deal with, and it can't all be revenue. We can't raise taxes on. Do you see a way to do this politically?
Joe, there's a way out of it. We found a way out of a civil war and a country half slave and half free. We found a way out of 2 world wars. We found a way out of a Great Depression. This country has a lot going for it. You don't see it. You read about the headlines about what government is doing, but we have an economy that works very, very well. I mentioned in the annual report that I bought my first stock when we were losing the war in the Pacific, and since that time the Dow has gone from 92 to 14,000 or so. I mean, and the headlines were terrible. This country goes through all kinds of problems, and we'd like to talk about them when they appear and they're in the headlines, but we've got such a basically strong and good country that we will overcome what 535 people do, and it will work over time.
But you're still,
like
sometimes I think you're a Democrat, and other times I think you're a closet Republican. You think that the size of government shouldn't be above 21.5, 21% of GDP. You're not arguing that we should go to 25, because maybe we should be at 25% to make it more fair and to give more entitlements and to take care of our citizenry, sort of the way Europe does. Maybe we should go to 25, but you don't. That's not. You're not.
I'm not. No, I'm not there, Joe. I'm at 21.5 and 18.5 on revenue, and incidentally, that 3 points of gap will work out fine over time. I mean, that will not take debt as a percentage of GDP up. So it's very workable. It doesn't seem like a day by day, perhaps, but it's very workable.
Well, maybe in a good economy, we don't need to cut. Maybe we come down, and people need less assistance. So maybe we won't stay at 25 or whatever. Maybe we get back down and then maybe the revenue goes up in a good economy, and both sides shrink. Is that what you think finally? And we do something with means testing, or I don't know. Maybe we solve our.
Yeah, well, means testing. Yeah, but we aren't at 25 right now. I mean, if you look at 3.6 trillion of spending and 16 trillion of GDP, that is not 25. It'd be 4 trillion if it was 25. It's about 22.5.
So we're getting there. All right.
Yeah, we'll get there.
Okay. Let's bring in that question from a viewer, Charlie Silver, which kind of plays into what Joe was just talking about. He wants to know if you are still as optimistic about the American economy and the stock market as you were when you wrote the op-ed piece in the New York Times in November 2008. Maybe you were more positive about the stock market then.
Well, stocks were cheaper.
Stocks were cheaper then, and maybe you're more positive about the economy now?
Well, I'm always positive about the economy long range. I mean, this country works. All you have to do is look at, just in my lifetime, 6 for 1 on real GDP per capita. You can't see it, but we have millions and millions of people out there trying to figure out how to make their lives better tomorrow. And they create companies like Oriental Trading. This was created by a young fellow here that had a couple of parents that had come over from Asia, and so you look at it, 750,000 square feet. We create things. Geico was created by a fellow and his wife back in 1936 that had $100,000. I mean, so the dynamism of America is not lost.
We're always looking for the next big thing, and Jim Cramer wrote in. He's got a question about whether we're at the golden age of oil and gas and how Burlington is cashing in on it in terms of the train to the refinery. Will BNI switch to natural gas engines on its locomotives, he also asks.
Well, we've got a couple of locomotives we're experimenting with this year on it, yeah. I think, and we're probably not the only one. The railroads are definitely experimenting with converting to natural gas. It's not a simple matter, and I can't tell you the technicalities of it, but it's real enough so we're spending real money. In fact, I think we ordered a couple of units that we're working with. So when you get natural gas, $3.50, and you look at where oil is, you've got to look at converting any kind of an engine to natural gas.
But Jim brings up a point that we've heard from Jack Welch and others who have come on the show. I mean, Jack Welch has said he thinks oil and gas is going to be one of the next big renaissances for America, and that may be where we get a huge number of jobs from down the road.
Yeah, well, it's huge. The job factor is significant. It's not like I don't look at it primarily in terms of jobs, although that's important. But it's certainly important in terms of the balance of payments, which is, I mean, we can save hundreds of billions of dollars annually as we get more self-sufficient in oil and gas. So it's got big consequences.
And you did mention a little earlier what this means for Burlington Northern, but it's been a big boon for them to be coming from the Bakken, to have so much around the Bakken oil formation to be able to bring that oil out.
Fortunately, they discovered oil where our railroad was. Now, it's still only about 5% of our shipments. We ship a couple 190,000 cars a week, and it's about 5% of shipments. And coal's 20%. So what we've lost in coal, we've more or less made up in oil. But it's a growth factor. There's no question about it.
Real quickly, Warren, I've been getting some questions via email and on Twitter about some comments you were making in the last hour with Joe, talking about some of the newspapers. Someone had written in, Steve Williams, this is number 55, who says, is buying newspapers like collecting cars for you, or is there a real profit motive?
Oh, it has to pencil out, or we wouldn't be doing it. It's smaller than the things we do normally, but we spent the $350 or so million. We will get a decent return on that, unless the business is way worse than I think it is. And I would say this, in the year or so that we've operated, we are meeting all the projections and a little some. We will never get super rich on it, but I can almost guarantee you that we will get a decent return on them. But we're buying them very, very, very cheap.
Another viewer, Robert Cunningham, wants to know if you'd ever consider the Chicago Tribune or the Los Angeles Times, because it's been reported they're up for sale.
No, thanks. They're too tough. It's very hard to edit a paper like the Los Angeles Times or the Chicago Tribune. If you have a paper in Grand Island, Nebraska, like we do, everybody there is interested in how the high school teams are doing, whether it's in wrestling or basketball or at the state tournament or anything else. If you've got the Chicago Tribune or the Los Angeles Times, you can't talk to the people about what's happening with their high schools. It just doesn't work. You need a tight community.
Let's get back to Becky and Warren Buffett for the last word. Becky.
Andrew, thank you. Last word, Warren, is a sort of free word association game that we've been playing lately. I say a word, you tell me what it makes you think of, and the question we get most frequently from people about you coming on is, what should they be buying right now? So if I say buy, you say?
I say basically hold. I mean, the idea that the European news or a slowdown in this or that or anything like that, that would not cause you if you owned a good farm and had it run by a good tenant. You wouldn't sell it because somebody said, here's a news item, you know, this is happening in Greece or something of the sort. If you owned an apartment house and you got to raise your rents a little, it was well located, and you had a good manager, you wouldn't dream of selling it. If you had a good business personally, the local McDonald's franchise, you know, you wouldn't be thinking about buying or selling it every day. Now, when you own stocks, you own pieces of businesses, and they're wonderful businesses. You can pick the best businesses in the world. And to buy or sell on current news is just crazy. You're in a wonderful business. You got people running it for you. You know you're going to do well over 5 or 10 years. And to think news events should cause you to try and dance in and out of something that's a wonderful game is a terrible mistake. So get into a bunch of wonderful businesses and stay with them.
But you said, I said buy and you changed it to hold. Does that mean don't sell, or does that mean?
Well, I mean, if you haven't got them yet, you buy them consistently over time. So you sort of average over time. And I've been buying all my life. I bought my first stock, you know, when I was 11 years old, and it was about 3 months after Pearl Harbor, and Corregidor was falling, and they had the death march at Bataan, and all the news was terrible. It was a great time to buy stocks. And I should have held that stock forever, and I've been buying stocks ever since.
So, right. Guys, you have any last quick thoughts? Go ahead.
I do. Warren, have you met Zuckerberg, and if you sat down with him and he told you, is there any way that he could explain the business well enough to you to where you'd take a huge stake in Facebook?
Probably not. That doesn't mean that I'm negative about it. I just don't understand it well enough. And I'm actually not even a member. There's a billion of them out there. So I like to buy things where I feel I've got a reasonable idea of how the business is going to be doing 5 or 10 years ago, just like for 10 years from now, just like I would buy an apartment house or a farm with the idea that I would think it was going to be a good thing to own 5 or 10 years later.
There is a watershed event tomorrow that might change your view, and you are free to send me questions as well if you'd like, Warren. But this is a game changer for Facebook.
Curtin's going to be on Facebook. So.
Well, actually, Joe, I thought instead, you know, you've always wanted a share of NetJets. I've got a NetJets tie here, and instead of giving you an 8th, I'm going to take this. There's dozens of planes on this, and I'm going to give this to Becky to take back to you.
Wow.
You are now a major net. I mean,
here we go, Joe.
Yeah, exactly.
Here we are.
Thousands of jets, and I'm getting a tie. All right.
Dozens of planes.
Right.
Dozens of planes on it.
Warren, thank you very much for your time today.
Thank you.
We appreciate it.
Thank you.
I am back again with Berkshire Chairman and CEO Warren Buffett. And Warren, let's talk a little bit more about your letter and some of the things you put out this year. You mentioned that you're going to be doing things a little bit differently this year at the annual meeting. Last year, you added a panel of analysts who asked a lot of questions at the annual meeting, along with the 3 journalists who asked questions and all the questions that come from the audience. This year, you say you're still going to have 1 insurance analyst, but you've added another analyst who will be looking at the other Berkshire companies, the other Berkshire subsidiaries or units or businesses, whatever you want to call these. And you're also actively looking for a bear on Berkshire Hathaway. Why did you add that?
Well, I just thought it'd make it more interesting. You know, the crowd can hear somebody that thinks the stock's overpriced or that it's all a house of cards or whatever it may be. And we want the meeting to be interesting. So that person will get 6 questions, and we now have that person because I said it had to be a credentialed bear, preferably one who was short the stock. And Doug Cass is certainly a credentialed investor, and he says he's short the stock and he'd like to do it. So, Doug, you're on.
Does he know this?
No, he just knows it now.
Joe, Doug actually wrote in, I think on Friday or Saturday after he wrote the note, and we kind of forwarded that on. So, Doug, if you're watching this morning, you're it, buddy. Make your plans for that weekend.
Think of tough questions. See if you can drive the stock down 10% when you show up.
Why? So you can buy back more shares?
Yeah, that would be okay.
All right. So let's talk about some other areas of things that you really brought up in the annual meeting. You talked about accounting, a long section on accounting, and you admitted at the end you'd be putting down the dentist drill. But why did you get into accounting this time around?
Well, accounting is, I've done it before, too, and accounting is the language of investment and business. And to some extent, it's not well explained in certain cases, and sometimes people draw the wrong conclusions. So I like to stick in a little essay occasionally on where I think accounting falls short and how an investor or a business person has to think differently about it than going strictly by GAAP accounting. And then when I have an example that fits that, I'll write about it. And I know that isn't of interest to all of the shareholders. There's plenty of people that skip over that part. But I also think it's important that people understand it. We have some peculiarities in our own accounting, and I want the shareholders to understand it.
And your problem with the thing that brought it up this time around was the purchase of additional shares of Marmon?
Well, we had a situation where we actually we bought originally 64% of Marmon. Then we bought some more. This is all pursuant to contract. And we had to immediately write it down. If we just bought that amount by itself, we wouldn't have had to write it down. But because there was a transition between two rules, we actually had to charge off this year $700 million immediately upon the purchase of something that did not shrink in value $700 million. And we want to explain that. I would want that explained to me if I was a shareholder and my management did it. So I want the facts to be there. And admittedly, it can get kind of tough sledding there for a while for some people, but it's there to explain what goes on, and we get into it in terms of amortization of intangibles, and in the end, I've got two very smart sisters that have most of their money in Berkshire, and I want them to understand things and that affect the value of it, and I'm talking to them.
Okay. Warren, if you were to look around, a question we got again and again, and I know we've talked about this a little bit, but for people who are just tuning in, there have been people who have been writing in who want to know, if you look at the S&P 500 right now, do you think that stocks are undervalued or overvalued?
Well, I think they're undervalued relative to other assets. In other words, if I had a lot of money today, I would rather own equities than own fixed dollars, long-term government bonds, junk bonds, farmland, REITs. They will be affected if interest rates go up dramatically. All assets will go down in value because interest rates to investments are like gravity is, basically the physics. I mean, everything goes off of interest rates. But the cheapest thing around, I wrote that a year ago. I've been writing it for year after year. They're not as cheap as they were 4 years ago, but you get more for your money, and that's why we like buying businesses and we like buying stocks. You get more for your money there than you will get. The one thing that the dumbest investment, in my view, is a long-term government bond. Mm-hmm. I think a single-family house is a good investment for people where it fits their living pattern and what they're going to do. I think that makes it, and you can finance it extraordinarily favorably, and I think that makes sense for people.
Okay, great.
We were turning out 16 million cars a year not so many years ago. When it fell to 9 and fraction million, when people were panicked, it was going to come back from that. The scrappage rate was higher. Americans hadn't lost their love affair with cars. More Americans were going to be in the country every year. So now it's back to, I think he said 12.4 or something like that in February. And it's going to come back beyond that. I mean, well beyond that. And that really isn't a function of saying cash for clunkers, or it isn't a function of monetary policy or fiscal policy. It's a function of the fact that Mike is out there trying to figure out ways to sell more cars. People want to buy more cars. Money is cheap. The economy is coming back, and it feeds on itself over time. And you will see 12.4 look like a very low number in a few years. And that is happening throughout America. It happens in different places at different times. It hasn't happened in homes yet because there was a bigger surplus to clean out. But in the case of cars, you can postpone it a day or a week or a month buying it. But scrappage rates count over time. Sure. And And there is a normal number of cars on the road for a given population in a place like the United States, and we fell below that for a while, and now we're coming back, and we're going to keep coming back.
Somebody just wrote in, wanted to know if you'd be interested in buying AutoNation.
Well, it's a good business.
Yeah.
It's a good business.
We're always looking for the next big thing, and Jim Cramer wrote in. He's got a question about whether we're at the golden age of oil and gas and how Burlington is cashing in on it in terms of the train to the refinery. Will BNI switch to natural gas engines on its locomotives, he also asks.
Well, we've got a couple of locomotives we're experimenting with this year on it, yeah. I think, and we're probably not the only one. The railroads are definitely experimenting with converting to natural gas. It's not a simple matter, and I can't tell you the technicalities of it, but it's real enough so we're spending real money. In fact, I think we ordered a couple of units that we're working with. So it's when you get natural gas, $3.50, and you look at where oil is. You've got to look at converting any kind of an engine to natural gas.
You know, but Jim brings up a point that we've heard from Jack Welch and others who have come on the show. I mean, Jack Welch has said he thinks oil and gas is going to be one of the next big renaissances for America, and that may be where we get a huge number of jobs from down the road.
Yeah, well, it's huge. The job factor is significant. It's not like I don't look at it primarily in terms of jobs, although that's important. But it's certainly important in terms of the balance of payments, which is, I mean, we can save hundreds of billions of dollars on annually as we get more self-sufficient in oil and gas. So it's got big consequences.
Warren, we got a couple of viewer questions, actually several of them, but I want to bring two up right now about BYD, since Carl mentioned this in his introduction to that question. Ray from Westminster, Maryland writes in. He says, everyone seems to be aware of your investment in BYD. That's the Chinese electric car company. The stock's deteriorated of late, and I can't seem to get a handle on the firm's profitability. Are they trying to compete on pricing only, or does their battery technology give them a clear advantage?
Well, the battery technology, if it works out like they hope it will give them a clear advantage. But battery technology is a evolving and tough game, and my partner Charlie particularly thinks that we've got the right fellow to make the breakthroughs in that area. But it isn't like you get it tomorrow or the next day. And there are a lot of smart people working on battery technology, and in the end, what I hope is the world gets a great answer on it very quickly. And if it says made in Japan, made in China, made in the United States, the important thing for humanity is that we get great battery technology. Now, like I say, Wang Changfu is an amazing guy. I'm impressed with him.
The gentleman who runs
BYD,
right.
and my friend Charlie, who knows a lot more about batteries than I do, thinks that this guy is the second coming, more or less. So we'll see what happens on that. It's not easy. I mean, when you're dealing with batteries, the weight, the cost, there are plenty of problems involved. But I will bet significant progress is made by BYD, but there may be more significant progress made by somebody else in the next few years.
Tony in San Diego writes in and says that BYD's lost more than 60% from its peak in 2010. Do you consider buying more shares because of the current discount?
Yeah, well, who knows? Well, the one thing, you can talk about everything in my life virtually except for what we're buying or selling.
Okay, so that's a non-answer, but Joe, I know you've got another question too.
We'll always have more. Warren, I'm trying to figure out whether you, since we're on the subject of energy, it's fascinating how we're going to do this as we need more and more. And are you going to play it through utilities and not really think about what the input is for the energy? It's going to come from you're not smart enough to figure that out, or?
You've got it. You've got it. I am not. I'm not good at that. I got through physics okay in college, but that's just because I've memorized the formulas. I really never knew why when you turned a little switch, lights went on or the television went on, and I still don't know. So I do not have a mind that really has any special abilities at all in terms of things physical. So I leave that to others, and I just try and figure out whether people are likely to drink more Coca-Cola next year than last year. And I can understand certain, but I mean I can understand if you're the low-cost guy in auto insurance and people have to buy it, that you're going to do very well over time. But I am not good at insights about the future products, and I do not sit and try and figure out trends or any of that sort of thing. And I don't pay any attention to people to talk about them because I don't know enough to evaluate them myself.
Yeah, but utilities are going to be there delivering whatever it is that generates the energy, and so that's the way you're going to participate in that, because you haven't bought natural.
Fundamental.
You haven't really bought natural gas or oil in the ground or typically, right?
Not very often, no. And you know, I don't know. The oil picture 5 years from now will be, may be much more dependent on politics than whether I can pick the best geologist in the United States. And you know, I know we'll be using more natural gas. I know it's got all kinds of advantages, and it's cheap on a BTU equivalent to oil, and it's cleaner, and all kinds of things. But in the end, the price depends on supply and demand. And even though demand will go up some, I don't know whether supply is going to go up even faster than that. And so far, it's been, in the last few years, I should say, that natural gas has been pretty disappointing. It hasn't been disappointing in terms of finding it, hasn't been disappointing in terms of its performance. It's just been there's been too much of it around, and I don't know. I'm not good at figuring out, whether that will change a year from now or 5 years from now, and I'm not in that game.
I do like your point though about batteries, and it's a tough hill to storm, but if you could take that hill and turn batteries into something other than what they are today, that has implications for solar, certainly for BYD. Would you say, Warren, that the evolution of batteries is where you are most leveraged to innovation in tech?
Well, perhaps. And Carl, you're 100% right. I mean, it's going to happen. It may happen at BYD. It may happen, with General Motors. It may happen in Japan. Lots of smart people are working on it. And it's a tough problem because you got so many smart people, and it is proving tough to get accomplished. But it's going to happen. It will happen. And I'm not the kind of a guy normally that makes a bet on who's going to make it happen. I'm just not that. I'm not that good at picking the winner in something like that. I know who's going to win in soft drinks. I know who's going to win in chewing gum. I know who's going to win in auto insurance. But that doesn't really take any great insights. My partner, Charlie Munger, believes very strongly that BYD is the most likely winner in this. He's got and he is a lot smarter than I am on this subject and a lot of other subjects. But that doesn't mean I'd shove all my chips out on the table just because Charlie feels that way.
Last Word, Warren, is a sort of free word association game that we've been playing lately. I say a word, you tell me what it makes you think of, and the question we get most frequently from people about you coming on is, what should they be buying right now? So if I say buy, you say?
I say basically hold. I mean, the idea that the European news or slow down in this or that or anything like that, that would not cause you, if you owned a good farm and had it run by a good tenant, you wouldn't sell it because somebody said, here's a news item, this is happening in Greece or something of the sort. If you owned an apartment house and you got to raise your rents a little, it was well located, and you had a good manager, you wouldn't dream of selling it. If you had a good business personally, the local McDonald's franchise, you wouldn't be thinking about buying or selling it every day. Now, when you own stocks, you own pieces of businesses, and they're wonderful businesses. You can pick the best businesses in the world. And to buy or sell on current news is just crazy. You're in a wonderful business. You got people running it for you. You know you're going to do well over 5 or 10 years. And to think news events should cause you to try and dance in and out of something that's a wonderful game is a terrible mistake. So get into a bunch of wonderful businesses and stay with them.
But you said, I said buy, and you changed it to hold. Does that mean don't sell, or does that mean?
Well, I mean, if you haven't got them yet, you buy them consistently over time. So you sort of average over time. And I've been buying all my life. I bought my first stock, when I was 11 years old, and it was about 3 months after Pearl Harbor, and Corregidor was falling, and they had the death march at Bataan, and all the news was terrible. It was a great time to buy stocks. And I should have held that stock forever, and I've been buying stocks ever since.
Take a look at Lowe's, that company coming out with its earnings expectations today, and it beat expectations. Revenue came in a lot better than expected, too. You can see that stock is indicated to open higher, $27.80 to $28 after closing at $27.16. By the way, if you were listening to Squawk earlier this morning, you know that Warren Buffett is bullish on housing. Warren, you talked about how this is maybe the best place to put your money, maybe even better than the stock market?
Well, I think if you have a way to manage the single-family homes, single-family homes are selling at very attractive prices in many places, and the mortgage financing you can get is unbelievable. It's a great way to short the dollar.
All right. We are back here in Carter Lake at the Hollywood Diner where Warren's having the breakfast of champions. He just ordered a strawberry shake and he's ready to go with the markets. Warren, we've been watching what's been happening with the futures, and when we came in this morning, it looked like the Dow futures were off by more than 90 points. Right now, they're only down by about 75 points after all the news coming out of the elections. What's your take on it?
Well, the lower they go, the better I like it, because I'm going to be buying stocks today, and obviously I like buying stocks lower rather than higher.
So go on down, as you're kind of cheering, I heard earlier, like down, down, down as the futures.
You know, if you're a net buyer of stocks, you're better off if stocks go down. Right. And people generally don't feel that way, but we do feel that way. On top of that, we own stock in IBM, which is buying in its shares today, undoubtedly. We own stock in Wells Fargo, which may be buying them in. American Express is buying them in. Coca-Cola may be buying them in. So we are increasing our ownership in all four of our largest investments without laying out a penny. The lower those stocks are, the more those a given amount of dollars buys. So we are benefiting. As soon as the market opens, we're benefiting every minute if they tick down.
Okay,
and it's significant over time.
It is significant over time. That's part of the reason you liked IBM to begin with, correct?
Sure. We will. Our ownership of IBM has gone up significantly since the end of the year, without us laying out any money. And you know, if that happens long enough, it makes a lot of difference. We bought 6.7% of Coca-Cola some years ago. It's now 9% without us laying out another dime.
Same things happen with American Express. How much do you own of that right now?
I think we own about 14%.
13%, 14%?
Yeah. And it goes up, and we haven't bought a share for, I don't know, 10 or we can't buy it because it's a bank holding company. But our interest in the company goes up, and we love it. It's a wonderful business, and what's better than owning more and more of a wonderful business without laying out any money?
Right. This weekend at the shareholders meetings, there were about 35,000 shareholders who came in through Omaha. Was there anything in the questioning that caught you by surprise, or that maybe you learned something from?
Well, the questions just generally were good, and of course, to some extent, you learn what's on the shareholders' minds, and to an extent, I will even think about addressing next year in the annual report the kind of questions that the answers to the kind of questions that we get, and it tells me what shareholders, what I haven't communicated perhaps well enough to shareholders.
What was one of those topics?
Well, one of the topics I've discussed it before, but we've discussed a logical stock repurchase program in this year's annual report. I think we'll discuss a logical dividend policy in next year's report. I've addressed that before, but
you said yesterday though you would not consider a dividend at this point.
Well, no, but we can discuss the conditions under which it makes sense to pay dividends, how much should be paid in dividends, and when it doesn't make sense to pay dividends, and that should be discussed. Will probably be discussed in the annual report, even though I've written about it in the past.
Yeah, when does it make sense? I mean, when you basically can't find anything else to do with your money?
It makes sense when you can't keep money in the business and generate more than $1 of present value by using that money, and then you should distribute it.
What should a company like Apple do with all the billions and billions and billions of dollars that they're sitting around?
Well, I got a call from Steve Jobs, as I mentioned to you once a couple of years ago about that question, and it's very unlikely, at least when I talked to Steve at that time, that Apple will ever find an acquisition that is in the many, tens and tens and tens of billions of dollars, and there's no sense sitting with the cash over time. So they either ought to pay dividends or they ought to repurchase shares, and I guess they're going to do both now.
Yeah. When you look at some of the issues that were also discussed this weekend, the question of succession came up in the shareholder questions, but more pointedly with that movement that was brought by the AFL-CIO, where they were asking for more specifics. That proposal got voted down. I think it was by 95% to 5% in favor of it. But people have looked at this situation with the question of succession, and nothing's changed from the board's perspective at this point, correct?
No, and actually the AFL-CIO, we were on the same page largely because they did not want us to name a name. They just wanted us to include something in the proxy material that related to how we were dealing with it. Well, we've always told people how we're dealing with it, and we put it in the body of the annual report this year, for example. So we were in a very similar position, and there was not a big disagreement on it. But if you look at our largest holdings again, American Express, Coca-Cola, Wells Fargo, IBM, I do not know the name of the next CEO of any of those four. I don't even have any idea who it'll be. When they picked their CEOs, I did not know who they were going to pick. I didn't know John Stump was going to be picked, some years ago at Wells or Ginny Rometty at IBM. I just knew that they had a board of directors who had the job of picking the best person available when the time came, and they did it. And our board spends more time on the subject of succession. We'll meet here in another hour or two, and we will spend more time talking about succession than any other topic by far. And we're blessed in the sense that we've got multiple candidates, and they're with us. We know them well. We've seen them perform, and it is not a problem.
You just mentioned Ginny Rometty at IBM, and it reminded me of a headline that you made this weekend when you made some comments about how, as a member of Augusta, you'd be okay with women being admitted.
Yeah, but I'm not on that committee.
So they haven't asked you?
No. And I knew they wouldn't ask me when I joined.
Are you okay with being with the club? Obviously you are, as you're a member of the club.
I'm okay,
Yeah, one way or the other. Why don't we talk a little bit about some of the other headlines that have been out there?
Hey,
Joe
Becky?
mentioned before the Walmart situation. Yeah, go ahead, Joe.
Yeah, sorry, Beck. Paul Masano became a member, but he was a CEO for 5 years before he was a member. So who knows what the club finally does? But I don't think people know that. They figure Paul Masano immediately was because they're sponsors of the Masters, but it was 5 years before he was finally invited in. Warren, how long did it take you to get in, too? I mean, and especially with your skills, I figured they would have had a silver platter if they had seen you play.
I made just the opposite appeal. I'm the highest handicap member of the club, and I am in there as part of their outreach programs. That was the appeal I made. It was my only chance.
Gates too, right?
Yeah. Oh yeah. Well, yeah. He may be the second highest handicap member, but I definitely hold the title, and they need me if they're going to show they're democratic in terms of of taking any kind of golfer. They need me.
letting you and Gates in is much more open than. I mean, that just shows you they don't discriminate against really bad golfers.
You've got your. I will not argue that point.
Likewise, I don't.
Joe, I'm sorry. Did you want to ask about Walmart? You had asked that before.
I wanted to ask her really. I wanted to ask her. I really struggle with this, Warren, and as a shareholder, I mean, I look at the piece that we saw from Holman Jenkins, which talks about the best way to bring a developing country like that up to speed is to, one of the ways to get rid of graft and corruption and everything is development. And the net good that Walmart is done down there in terms of jobs, in terms of bringing cheap goods to the population of Mexico, I really struggle with, I'm not a shareholder, but if I were, if I looked at all the net benefits and net costs, even PR costs, to get that jump start in Mexico and to do in Rome as the Romans do, I could almost make a case that as a shareholder, I would feel really ambiguous about the decisions they made down there. I mean, are you willing to say just outright they should have never done anything in terms of trying to grease the skids down there?
No, I hear your argument, but in the end, when in Rome, you can only do what the Romans do unless it's against the law in your own country.
But maybe the law is antiquated. And I made the point that let's say that you were in sub-Saharan Africa, and that there was a government there that wouldn't allow you to bring in vaccines for children, and that Bill's got a big interest in that. And for whatever reason, it's one of these governments you just can't deal with at all, but you find out there's a way to do it through bribes. Would you do that? Well, you would do that. It's against the law, but you would do it because the I hate to say the ends justify the means, but in that case, 9 out of 10 people would say go for it.
But that's a different case. I mean, when you talk about bringing in vaccines for children versus building a new store.
It depends on what you think is.
This is so untoward.
What?
Because bribery unto itself is untoward.
Okay, then you would never do it.
You know where I stand on this. I would not.
I don't know. Walmart would definitely not be where it is down there.
And you know what? Maybe that's okay.
But as a shareholder is what I'm talking about. It has benefited
It's a very tough issue.
Yeah. Go ahead, Warren.
You are at a disadvantage if you're in a country where there's a lot of corruption, and your own country says you can't engage in it, and some other country doesn't say their particular companies can engage in it. But in the end, you've got to follow the laws of your country, and you've got to have people working for you that believe that you follow the laws of your country.
Then you would think that the CEO, if he knew all along what was happening, and then they decided to not investigate it in a more strict way, then he should go then.
Well, I don't know the facts about the CEO or anything, but I do know this. The thing I worry about at Berkshire is that with 270,000 people, somebody's doing something wrong. I'll guarantee you they're doing something wrong today. I mean, we probably have 10 people, maybe 20 people doing something they shouldn't be doing today at Berkshire. What I hope is that we find out about it, that it's minor, and I certainly hope that we hear about it and get it corrected. But you can't have a huge anybody runs a huge organization. I don't care whether it's a church or an army or a political organization, a governmental department. I mean, that's what haunts you, is that down the line people are doing things that they're not supposed to be doing, and you have various methods to try and keep that under control. You'll never solve it 100%. You have to make sure when you do find out about it, you do something about it.
Hey, Warren, if we learn within the Walmart issue that somehow it really did get to the board, and that there really was a cover-up of grander proportion than even we know, would that change your view about whether you want to own the stock, or is the business unto itself so solid that it doesn't matter who's running it?
Well, I really don't want to get in the hypothetical of going to the board, because I don't think it did. I mean, I'll take some other company, the XYZ company, and my guess is if something really terrible got to the board and they didn't do anything about it, you'd change the board, and then there would be no problem owning the stock, in terms of a new board being there. I don't think it's a reason to throw away a business because if one of our subsidiaries, if somebody does something wrong, the answer is not to get rid of the subsidiary. The answer is to get rid of the person that did something wrong.
Mm-hmm. You've said in the past that you want to own businesses that could be run by a ham sandwich.
Yeah, well, that's true. But I've also said we always want to have business. We want to have people to match our principles and not principles to match our people.
Okay. Warren, just a little bit out of left field here. You did an interview, I don't know, about a month ago or something, where you were asked who was the most difficult person you've ever had time talking to, and you came up with an interesting answer.
Well, it was Jackie Kennedy and Princess Di. Yeah, I was in a room alone one time with Princess Di at a party, but somehow we found ourselves in this library, and in 15 minutes, I don't think I could think. I had trouble remembering my name. I couldn't think of anything to say, and it was a total disaster. But the more interesting thing is, I only met her one other time. It was a party at Kay Graham's house, which was where the first party was, and it was shortly before her death, very shortly before her death. And I was at the table. They put me across the table after my previous disaster, but she was sitting between Barry Diller and Teddy Forsman, and after she died a few weeks later, all these papers called and said, would she talk about that evening? I didn't tell them, but I will tell you today that a comment she made, which is absolutely true, and I can see Barry and Teddy's faces as she said it. She had been to the White House that day, and she said that Bill Clinton was the sexiest man alive. I didn't ask her who the least sexy guy in the world alive was. I was afraid I might get my play in there. But Barry and Teddy, they tried to keep their faces steady as she made that proclamation. But that's the last thing I heard from her before she died.
Wow. Okay. Andrew, Joe, on that note, I'm going to send it back to you guys. We're going to come back with more in just a moment.
I don't know where, I just...
Let's say something.
What could be said? Who is the sexiest?
What would I say? I would say that Bill, obviously, I've heard that about him, Becky, and you've told me that about him, too. He will look at you like
I
you're
didn't say the sexiest man alive, but I will say
he will look at you like you're the only person. You're the only person in the world. So that's what you'd say. Like you're the only person in the world. I think he could make me feel like he was the sexiest man alive. Right?
He has not heard this before, so he's probably having a good day today. I've never told him this.
No, but it's true. He's a person who walks into the room and focuses on you and makes you feel like you are special no matter what.
Yeah. I mean, when Princess Di was looking at me and said that he was the sexiest man alive, the fact she was looking at me did not make me feel like that.
Make you feel any better, right?
And that whole, you saw how many jokes there were. If it had been Bill down in Colombia with the Secret Service guys, you've seen the jokes. It would have been a whole different ball game probably down there. I'll tell you, right? I mean, a lot of high fives probably.
You're on your own, Joe.
Yeah. The single box, please. Get rid of the rest of us.
I'm willing to go there. I've gotten a lot
I'm
of
being
them.
told by the producers to save you.
Welcome back, everybody. This is a special edition of Squawk Box. We're live in Omaha with Warren Buffett, who's taking the time to sit down with us today and not only answer our questions, but also the questions that you've been sending in as well. And Warren, we appreciate that. We got lots and lots of questions that came in. Carl mentioned that the probably most intriguing line of your letter was this idea that your elephant gun is loaded and you are ready. Got an itchy trigger finger. That's what sparked a lot of the questions that came in. So do you mind if we play rapid fire real quickly with some of these questions?
Okay, go to it.
All right. The first one, let's say, comes in from Michael in Canada, who writes in, with articles mentioning that you're looking for major acquisitions, with the economy favoring the low-cost segment, wouldn't Family Dollar be an ideal fit?
Well, there are a lot of companies that would be a fit at a price. It's easier for us to buy businesses that are privately owned, the ones that are trading in the market, because people, I don't care what the market price is in terms of what they're worth to us, but generally speaking, people in evaluating mergers and acquisitions look at the premium paid to the market price and decide whether that's a fair price or not. A fair price to us is one where we think we're going to get our money's worth in terms of future earnings. And I would say that we will generally have more luck with private businesses than public businesses, although Burlington was a public company. Most good companies sell at prices where if we were to pay a 20% premium to market, I would not want to buy them. I mean, if you look at 50 large companies that would sort of fit the elephant category, if you add 20% to that price, I don't want to pay that for the business. There's a few exceptions to that, but not very many.
All right, well, let's talk about a private company. We had Whitney Tilson on our air earlier this week. He said he knows nothing, but it struck him that Mars might be an interesting company.
Well, Mars is a wonderful business, and we're their partners in Wrigley. And if the Mars family were to ask me about selling their business, I would say keep it. I mean, if you own a wonderful business in life, the best thing to do is keep it. All you're going to do is trade your wonderful business for a whole bunch of cash, which isn't as good as the business. And now you got the problem of investing in other businesses, and you probably paid a tax in between. So my advice to anybody who owns a wonderful business is keep it. Now, sometimes there's some reason in terms of taxes or family situations or whatever it may be that a wonderful business is for sale. But I have told a number of people who have come to me who have wonderful businesses, if you can figure out a way to keep it, because all you're going to do is take that $1 billion you get, or $5 billion, you're going to pay some tax on it. Now you're going to go out and buy some stocks, and most of those stocks you buy are not as wonderful as the business that you already own, and you don't know as much about it, and so sometimes it pays to know when you're well off.
So why does anybody ever sell to you?
Well, they sell because families subdivide, procreate, or whatever you want to call it, and sometimes people lose interest in the business. We bought a company called See's Candy, one of our very first purchases back in 1972. Mary C. had several grandchildren, and one of the grandsons was very interested in running the business, and one was less interested. And the one that was interested died, and the one that was less interested then decided to sell. There's human dynamics that enter into it, but you should never sell a good business just to get money. That does not make sense.
Okay, let's take a few more viewer questions. This one's number 96. And again, this is Paul in Thailand who wants to know, on this unloading the elephant gun, are you planning to unload in the United States or outside of the United States?
Any place I can. I can't afford to be picky. There's so few chances out there that 4 or 5 years ago, I was very lucky because I got a letter from Israel about Iscar, and I'd never heard of the company before, but I could tell it was our sort of business and our sort of management. So I would hope to get another letter like that tomorrow, and I don't care whether it comes from the UK or Germany or France or wherever. It's more likely to be the United States than any other place. But we have certainly not bought our last international company.
Well, someone else writes in, Sergio from Mexico. He wants to know, is there some reason not to use the elephant gun on the stock market? For instance, increasing Wells Fargo to the 10% limit or buying a lot more Walmart?
Yeah, well, in the last year, we've done both of those things. We've bought some more Walmart, some more Wells Fargo. And I like those businesses, and I like the prices at which they sell, and I like the managements. But if I had my choice, I would rather buy a big business that fits all our criteria. But we have 60+ billion in common stocks, and those are pieces of businesses that I like. And most of those businesses, now Wells Fargo we couldn't buy. We can't buy a bank. Coca-Cola isn't going to sell out to us. Walmart isn't going to sell out to us. So we would be very happy owning 100% of those businesses at the prices at which they sell, or otherwise I wouldn't buy the stock.
Okay. Roman from Pittsburgh writes in, and I think I know the answer to this one, but he wants to know if you'd be interested in purchasing more U.S.-based railroads at the right price. You can't do that, correct?
That would be pretty tough, yeah. And in fact, when we bought the BNSF, it wasn't actually required by law, but we thought it was advisable to sell our holdings in the Norfolk Southern and the Union Pacific. And that probably cost me at least $1 billion. I liked those stocks. I mean, I knew those companies were going to do well. And legally, we didn't have to do it. We thought that probably was a good idea, and now I think it's a bad idea.
But it's not a reflection of your vision for the rest of these.
Oh no! I thought I would have bought more of those railroads. The railroads have a common future. The big railroads in the United States have a common future. Now I like the ones in the West a little bit better than the East, but there are fundamental reasons why railroads were going to do well, and. No, if I could be loaded with, at least at the prices of a year ago, if I could have been loaded with other railroad stocks as well as buy the BNSF, I would have done it.
Omaha is getting ready for Berkshire's annual shareholder meeting. Starts tomorrow. Becky Quick is live in Omaha, of course. Talked to the Oracle over the, I guess earlier yesterday, right, Beck?
It was last night, Carl. We got the chance to catch up with the Oracle of Omaha. He's going to be here on this stage tomorrow along with Charlie Munger, and that's where they'll be addressing about 35,000 Berkshire shareholders. You guys were just talking about Facebook, and obviously technology stocks, that's not where Warren Buffett has invested in the past, but he did say with Facebook, while he wouldn't be touching it himself, he does not think that social media, the networking stocks at this point, he does not think it's the same type of bubble that we saw back in 1999, 2000. He said that we are not near that craze where you can just slap .com on anything and it will sell. So that's a little bit of interesting insight just on the Facebook issue from him. It was not an all-out endorsement, but again, he was not saying that this is something that he'd seen before, like he called it back in 2000, 2001. What we did talk to him about last night, Carl, also was what happened with the jobs picture. Now, a lot of times he won't give guesses on these things, but we were able to pin him down, and he took the under on the consensus estimate for the jobs number. He was right on that call, and when we asked him why, he said it was because of what he's seeing in the economy. Obviously, he has a very good sense of what's happening based on the almost 70 or almost 80 companies that Berkshire Hathaway owns, along with all the big blue chip stocks that they have major percentages in. Listen to how he sees the economy at this point.
Well, I would say that we're still seeing an economy that's improving, but it's not at a fast rate. Now, it's been improving quite steadily since the fall of 2009, but the trajectory has been just, it's a very small angle, and that angle has not improved in the last few months. So, if anything, the economy is better now than it was 3 or 4 months ago, but it's not a lot better.
Why do you think that it's not improving at a faster rate? We talk to people all the time who will blame everything from Washington to demand, but what's your take?
It's because home construction hasn't come back. That will have a huge effect. When we start needing to build as many houses as we have households formed, you'll see a major change in the economy and in jobs, in my opinion. And, you know, that will happen, but I'm gradually learning not to predict when.
Guys, we also talked to him a little bit about Meredith Whitney and some comments she made yesterday. She had said that as far as she was concerned, the banks have really seen their peak in terms of earnings with the first quarter. She thinks it'll be very hard for them to replicate what they've done in that first quarter. Buffett said that when it comes to Wells Fargo, at least, he would take the other side of that bet, that he thinks with Wells Fargo, you will see quarters later in the year where they earn even more than they did in the first quarter. And that's an interesting call, too, because, guys, we've been watching so closely with earnings, how they've come in. And there have been a lot of naysayers who don't think companies can continue to earn numbers like that.
Becky, I'm curious because this is the first time that you're able to actually see Warren in person since the announcement of his diagnosis with prostate cancer. Was he surprised at all at how much chatter and the reaction in the stock right after the announcement that we saw? I just spoke to an analyst last night regarding Berkshire Hathaway, and he said there's a 10% premium in the stock because of Buffett.
Yeah, I don't think he's surprised at all by the attention, the amount of attention it received, and I think that's why he took that step to go ahead and issue a release. Melissa, last night was the first time I'd seen him since that release came out, and he looked like his normal self. He said that he felt great. And again, he took that step of putting out that press release describing exactly what his condition was and why the fact that he had prostate cancer, which a lot of people wouldn't have done it, but he said that C word, the cancer word, is one that has a lot of connotations to people, and he just wanted to set the record straight. So I don't think he's surprised by how much it came out there, and I do think it'll be a topic of discussion here tomorrow at the meeting.
All right. Becky.
Can't wait for Monday. Enjoy the
Thanks,
weekend.
guys.
We know you'll work hard. Becky Quick joining us in Omaha.
Yeah, those are grueling days. So that just
especially
goes to
when
show
you're taking your 1-year-old. Not even, right?
I can't imagine.
Barely one.
Oh, really?
Kyle's
He's on the road there, too?
yes.
He's going to be participating in the interviews?
His first shareholder meeting.
Warren Buffett is in South Korea today. Becky Quick is traveling with him at an event there. He said that Japan's devastating earthquake is the kind of extraordinary event that creates a buying opportunity for shares in Japanese companies. Becky, as I mentioned, is traveling with Warren Buffett and will join us with a live report in the next half hour. And on the plane ride to Asia this weekend, Becky asked Buffett why he was making this trip. Take a listen.
Why am I on a plane today? Can you keep a secret?
Sure.
Oh, okay. This is just for you. And whatever you do, don't tell anybody at Goldman Sachs. But yesterday, they called Berkshire's preferred. And that preferred has been paying us $15 a second. So tick, tick, tick. Yeah. But in calling it, they have to give us 30 days notice. And they apparently sent some registered letter to me. I haven't received it yet. So I decided to take off. I am going to be the Osama bin Laden of capitalism. And I'm on my way to an unknown destination in Asia where I'm going to look for a cave, let my beard grow, and if the U.S. Armed Forces can't find Osama bin Laden in 10 years, let Goldman Sachs try and find me.
Warren, how much money have you made on this investment since you first put it in back in 2008?
Well, we put in $5 billion, and for that we got two different securities. We got a preferred, which has been paying us 10% a year or $500 million a year. We've had that for 2 and a fraction years, so we've probably gotten $1.2 billion or $1.3 billion in dividends. That will be redeemed at $5.5 billion. So that will then have the dividends plus a $500 million profit on that. And then we have warrants on 43 million shares plus at 115, which if exercised today would be worth a couple billion, but they have another 2.5 years to run. So if we close it all out today, we'd have maybe 3.7, 3.8 billion of profit, but we're not closing it out today.
Welcome back to Squawk Box, everyone. The euro has been under quite a bit of pressure this morning after the news over the weekend about the elections in Greece, Germany, and in France. Right now, it's trading just a hair above 130. Obviously, though, there have been some people who questioned why the euro hasn't seen even more pressures based on all the troubles they've been having there. Over this weekend, we got the chance to catch up with Bill Gates, who is a director at Berkshire Hathaway, and he talked a little bit about his thoughts on currencies and why you've seen some of these things happen. Why don't you take a listen?
There's some of these currencies like, the Canadian dollar where you can say, okay, they've done a better job, therefore won't they benefit over time. The challenge with currencies is all the big ones have some difficulty It's not like the Americans have solved their deficit. And when you bet on a currency, you're looking at that long-term thing. What is the equilibrium at which the U.S. starts to pay back the net debt that it has externally, which is primarily to oil-producing countries, a little bit to China? Clearly some currency equilibration will be involved in that. So it's not like you can say, okay, I'll just buy the dollar. Also, most investors, including myself, most of your things are naturally in a dollar. So you start out, you could say, overweighted in the dollar, and you have to go to quite lengths even just to get neutral. And then the question is, okay, if you don't like the euro, how do you get neutral? There's not that many heavily traded currencies other than the euro.
Again, we are live with Warren Buffett this morning. And Mr. Buffett, you hear those comments coming from Bill Gates, and it's a good question. For a lot of investors like himself, he is already overweighted in the dollar because he owns everything in it. So what do you do?
Well, Bill and I probably talked about currencies as much over the years as stocks. It's a fascinating subject, and Bill's done well in currencies, but we are all dollar heavy. I mean, it's natural. You're going to be dominant unless you make a very, very conscious effort. You're going to be very heavily weighted in dollars, and he's thought about it, and I've thought about it. And I don't like any currencies over time. I like the dollar better than most currencies, but I don't know whether Bill talked about the Canadian dollar there. I didn't listen to the whole.
He talked very briefly where he just said, you would think the Canadian dollar might do better over time because they've done very well and haven't gotten into a lot of the problems that we've gotten ourselves into.
Yeah, their economy has been run better over the last 10 or 12 years than ours. And incidentally, their banks are bigger relative to the size of their economy than ours are. So they've actually done it with bigger banks relatively. But I think Bill's done very well in Canadian currency, and I just wish we'd made as much money as he had out of it.
But as an investor, when you look at currencies, it's difficult when you're as big as Berkshire to try and find things that you can really move.
And we're in so many different ways. We have insurance liabilities in all kinds of currencies around the world. We have businesses earning money in other currencies. It would be very hard for me to tell you precisely where we stand in regard to the euro, whether going up or going down, how it actually affects us, because we have so much interplay between our financial assets and our operational aspects.
Do you worry about trying to hedge in currencies?
I don't worry about trying to hedge. No. Okay. When we bought Burlington, they would engage in a lot of hedging of their fuel. I mean, most companies hedge, but the truth is, if they really knew what those currencies were going to do, they might as well close down the railroad. We just play around with the oil market, and all of those things have costs attached to them. And I'm going to live a long time, and my guess is if we take all of the hedges of all the companies that we might be exposed to and added them all up over a 50-year period, net, they would have cost me money. So I don't worry about what we earn from quarter to quarter. And people that worry a lot about what they're reporting every quarter engage in a lot of hedges, which probably have an economic cost to them, but that they care more about what they report quarterly than they do about the net result over a 10-year period.
Let's talk about Burlington Northern. You've always loved the railroads because you say it's a very early indicator of how the economy's going.
I didn't love them early enough. I should have loved them a little earlier. But they're a very interesting set of statistics comes with them that tells you a lot about the economy.
So what are you seeing right now?
We're seeing that little bit of improvement month to month and over time. I mean, it's not much different than we've seen since the fall of 2009. In that it just keeps getting a little bit better consistently. Now you see, given coal is down, for example, and of course grain will depend on crops and all. But overall, I see improvement.
If natural gas becomes a bigger and bigger play over the long haul, we've seen recently some companies actually putting some real money into making the conversion to natural gas.
Absolutely.
Is that a big problem for the railroads?
No, you could even think in terms of natural gas. Being the fuel for locomotives. I mean, you get a big enough differential between oil and natural gas, and you'll figure out a lot of ways to do a lot of different things. And of course, we're seeing that in utility generation right now, and in terms of the move to gas.
What's MidAmerican doing? MidAmerican Energy doing? Is it looking to make that conversion to natural gas with anything, or to find other?
Where we have units that have the option of using gas with gas this cheap, most units don't move around that easily. So you're never going to have a major change in a short period of time from one energy base to another. But you know, gas is going to be the preferred method between gas, coal, and oil, obviously, in terms of utility generation now.
Warren, talk about board culpability a little bit. I'm trying to figure it out whether they would have even had a chance to know about this situation and what the protocol was, because when they finally did hear about it, that was a scathing report from the board and from the audit committee. I guess the criticism you're going to hear is that, like so many boards, you've got Warren Buffett, the most iconic American investor of all time. You wonder whether the board would rubber stamp things for you, or maybe that's not the case. Maybe they didn't have any idea about this situation, and when they did finally have an idea, they came out with, obviously, that report, which was much tougher than your initial assessment of the situation. How did that work, the timeline of when the board knew anything?
The board knew of the release, which I guess went out on March 30th. They received that earlier in the day, and then we had a board meeting about that release. Prior to that, they did not know of Dave's connection with Citigroup in this situation. I had been totally surprised about that when I learned about it on March 14th when we announced the deal with Lubrizol, and I got a call from a fellow that handles our equity trading at Citigroup, and he congratulated me on this Lubrizol purchase and was proud of the part that the investment banking group at Citigroup had taken in it. And I had heard nothing about that from Dave at all. So at that point, the next day, that's when we started questioning him about when he bought the stock, what his connection with Citigroup was, and the story unfolded at that point. So the board, well, actually, I was off to Asia then, and then I came back on the 26th, and the board really started finding out about it when we called a board meeting for Wednesday, the 30th, and we went through the events of the purchases, and then the audit committee. I think they first may have convened on April 6th, but that's in their report, and they've been very active garnering the facts. Now, they don't have the right of subpoena, and Dave did not appear before them. Like I say, they'd be delighted to hear from him this afternoon, and they would be glad, I'm sure, if he brought new facts to their attention to have an amended report. But so he's got an open invitation.
Are you ready to hang it up yet, Warren? After this is not nothing that you wanted. I know, and I think about the Godfather that when the Turk says to Tom Hagen, could they have gotten to the Godfather 10 years ago? Is there any way you could have gotten to him? And I'm wondering, could this have happened? Weren't you more, when you said you'd be ruthless at Salomon Brothers, would you have been more ruthless 10, 15, 20 years ago?
Well, no, but it's a hypothetical, but I would say this. I would say that Dave probably thought that press release was ruthless. The rest of the world may not have thought of it, but in effect, we were laying out a case with definitive facts. We called the head of the enforcement division of the SEC with those facts. He was gone. He was gone under circumstances which gave him the least compensation, no extra, which if we'd fired him, the question would have been whether we fired him for cause or not for cause, and that could have been litigated. And if it was determined he was fired without cause, and who knows how a lawsuit comes out, would have cost us considerably more money. So I think he probably felt it was pretty ruthless. In fact, to read his attorney's comments, I think that at least his attorney thinks it's pretty ruthless, even though his attorney really wasn't there when any of this happened. So but I plead guilty to not having that tone come through in the press release. I can assure you that in terms of the board meeting that was on Wednesday the 30th, I think the board felt that we were taking prompt and decisive action. And but again, I wrote the press release, so if it came off badly, it's my fault.
Warren, we only have a few minutes left, and I'd like to get to some of the other news that was mentioned this weekend at the Berkshire meeting. One of the things you said is that catastrophic losses at Berkshire for the reinsurance might actually come in at a loss this time for the first time in 9 years. That's a result of the Japanese earthquake, but also what happened in New Zealand?
Yeah, I mentioned that our insurance underwriting for the year could end up in a loss position. In fact, I would say it's most likely to end up in a loss position. And that'll be the first time I mean, there've been 8 consecutive years of underwriting profit. And it will do that from time to time when we have unusual catastrophes. And the first quarter, I think, will be the second worst quarter in the history of the insurance industry for catastrophes. Not only the Japanese quake and tsunami, but the New Zealand quake was quite severe. And then there were Australian floods and the cyclone and so on. So I would think it's considerably more likely than not that we have an underwriting loss for the first time in 9 years, but we expect them periodically. We are in the business of insuring catastrophes.
You also talked a little bit about the European banks this weekend. We've been watching with great interest, and surprisingly, the dollar's been weaker every single day, despite the issues that have been happening in Europe. How big of a problem do you think the European banks are at this point? What do you think ultimately happens?
Well, the European banks' problems will be proportional to the problems of the European monetary union, and you know that can be a huge problem. I said at our annual meeting, Jamie Dimon's analysis and J.P. Morgan report is very insightful on it. But having 17 countries that do not have similar fiscal policies and do not have similar cultures, but have to have a similar currency by signing up for it, can place strains on that I don't think we've seen even the full effect of yet.
Mm-hmm. We watch again, though, with the dollar weaker every day. Would you be, in the past, a few years ago, you did make a big bet against the U.S. dollar. Would you do that again?
Well, I wouldn't bet on it against other currencies. On the back of the U.S. dollar, it says, "In God we trust." And if Elizabeth Warren were in charge of the government printing office, I think it would have to say, "In government we trust," because that is all there is behind paper money. And governments can take actions that decrease the value of money, and sometimes at a very, very rapid clip. And I think that's what many people are worried about in this country, and that's why the price of gold and silver probably is a big part of the reason they've gone up.
We have also been watching Washington, and things have gotten much more contentious, especially with the national debt ceiling approaching. What do you think, if one side or the other, if there was not an extension of the debt ceiling, how big of a problem would that be?
It would be crazy, and the debt ceiling will get changed. I don't think there should be a debt ceiling to start with, but it's enormously, I mean, it leads to posturing and wasting of time and all sorts of things. They go through, and in the end, they're going to have to increase the debt ceiling, and it would be absolutely insane not to do it. The good thing in Washington, at least, is that both sides agree that the deficit is a big problem. They may differ in their solutions, but at least you've got a commonality of interest in the fact that it is a huge problem.
Mm-hmm. Joe, we only have a few minutes left, so if you do have another question you want to get in, I want to make sure you get the opportunity for that.
I do, and I just want to say, Warren, when you said it to shareholders, I made a mistake. That's good enough for me. I wanted you to hear you say it to our viewers too, because a lot of them weren't at the. And I understand that rules, if you can't trust a long-time employee, rules don't mean anything. But then I think about Ronald Reagan, trust and verify. I guess there's no one that can be trusted. But all that aside, the next question I had, it was something that John Malone said last week, Warren, and that was QE2's been great for financial assets. Stock market's doing great, but compared to an American's buying power with the dollar, we haven't gone anywhere. He's in land, he's in gold. Will this work itself out? Are we really at 13,000 on the Dow, or have we not gone anywhere because we've debased our currency so much?
Well, we're better off at 13,000 than we would have been by having the same currency problems and it being a lot lower. But John, that was a terrific interview with John. He's a very smart guy, and there's no question that if you keep interest rates at very close to zero, it drives people into other assets. I mean, people finally, it gets to them finally if their money market fund is paying zero, and it is true that we measure oil or gold in terms of dollars, but in terms of other currencies, they have not appreciated to the same extent. Government will determine the value of that piece of paper in your pocket, and recent actions, I would say, cause a fellow like John Malone to worry, and they cause me to worry a little bit too.
And Warren, just going back to the economy again, you did mention where you think things have been going. You talked about the tax on consumers from these higher energy prices. But what about housing? You had said in your annual report that you think residential housing could potentially see signs of picking up by the end of this year.
Yeah, it certainly hasn't shown any signs yet, so I may be wrong about my prediction on that. But the economy is getting better. And I think you will see major progress when residential housing picks up. And you'll see it in a whole lot of other places besides direct construction. And we just built a couple million, maybe 3 million, too many houses a few years back when we were building 2 million houses and household formation was 1 million. And we have an inventory of too many houses which we're working off. And at 500,000, we're working it off. And I don't know when the lines cross, but I know every day we're getting closer to when the lines cross. So we will have residential construction come back. That's the reason we bought a brick plant in Alabama. It's not because we're selling any brick now. And that will happen, and when it happens, you will see, I think, significant change in employment.
Joe?
Hey, Warren, last week doing strategy session, we also looked at periods in the past where Berkshire has underperformed the averages, and it was classic, because one was the financial stock bubble. The other one was the internet stock bubble. And now we showed gold and commodities, and now you're underperforming again. Those other two things ended really badly. And you didn't have to finally rush in and try to follow the crowd. I'm just wondering if we're seeing a replay of that now, what your feelings are.
Well, it's always possible when you get a big asset class that moves on price that after a while people forget about what the asset class represents and just get entranced with the fact that it went up a lot last week or last month, and that their neighbor, who's dumber than they are, had made a lot of money, and now their wife is telling them, why aren't you in gold or whatever it may be, or internet stocks that are moving. So that phenomenon will occur periodically in markets, and we don't try to profit from bubbles. We just try to avoid going broke from them, and so far we've been okay.
Hey, Warren, one last thing while I've got you here, because I don't know if you know. While we have you and you with all these mea culpas, have you ever released a long form birth certificate? Have we seen that from you, or I'm just wondering?
I was worried you're going to bring that up, and I really have no memories of my birth, and it may turn out I'm ineligible to be president of the United States, but I don't think anybody will cry over that.
My favorite line that you said was, "You want to be remembered." I love this. I'm going to use this. You want to be remembered as someone who is very, very old. And that is the greatest line. The other line is better, is if you could pick to know when you're going to die or where you're going to die, which would you pick? And I'd pick where, because I'm just not going to go there.
That's exactly right. And if Forbes would print a list of the 400 oldest Americans, and I was on that one, that's the list I really want to be on.
Right. That's exactly right. I want to be remembered as very, very old. Thank you very much for your time today, Warren. We appreciate it. And Becky will too.
Yeah, Warren, we want to thank you for joining us here at Borsheim's in Omaha again, and appreciate everything. And we'll talk to you again soon.
Thanks, Becky.
Okay, Joe, that does it for us from here, and I'll see you back there on Wednesday. Warren, thank you for joining us today.
My pleasure.
You know, at one point you turned to Charlie Munger today and you said, "Who haven't we insulted yet?" And I know you're not Charlie's keeper, but would you indulge me for just a minute?
Sure.
Let's go through some of the things he said today. I'd like to get your take on them. First of all, on short sellers, he said, we don't like trading agony for money.
The reason he said that is because the stock, when you short it, can theoretically go to infinity. When you buy a stock at 10, you can only lose 10 points. When you short a stock at 10, it can go to 100 or 200. And occasionally you'll get into a situation on the short where you may know that eventually it's going to turn out to be worth nothing or very close to it, or it's a fraud. But what it can do in between can be very, very unpleasant. And we like to sleep well, and you can't sleep well if you're short a lot of stocks.
Okay, when he was asked about Greece, Charlie said, let's see, letting Greece into the EU is sort of like serving up rat poison for whipping cream.
Yeah, well, I don't think I would not have chosen that. I think what he was getting at was that putting 17 countries into a monetary union where you synchronize the currency, but you didn't synchronize any other aspects of their economies. I mean, the fiscal policies, culture, cost of production, was doomed to failure. And he could have used other illustrations of countries.
All right, let's talk a little bit about bankers. He, on Friday, compared them to heroin addicts.
Yeah, well, that's colorful, Charlie. But I would say this, that leverage has enticed people to do crazy things for time immemorial. Bankers have an ability to attract money because they offer government guaranteed deposits. You've got a government guaranteed security. So unless there are limits on them, there will be great temptations to over leverage. And they did some of that, and they did it. They can do it through other instruments, off balance sheet things or derivatives or that sort of thing. So you really need limitations on people. And he would say that, he would probably say that heroin basically is leverage and the ability to borrow more and more money through deposits or whatever, and that should be controlled.
Would you go to regulation as strictly as he has laid out some of his ideas?
Well, we're in general agreement. There should be limitations on how much leverage you get in the system. And he and I are both suspicious of the degree to which derivatives can create a whole lot more leverage than people understand.
He also said on Friday that when it comes to high-frequency traders, he thinks it's basically legalized front-running.
That's what it is. Yeah, that's what it is. I mean, that's the whole game. And why let's say that high-frequency trading produces gross income of X. That X comes out of somebody. It doesn't make Berkshire Hathaway more productive. It doesn't do anything of the sort. It comes, one way or another, it comes out of the pocket of investors. And the social purpose of it is rather hard to discern.
Another thing Charlie had to say when he was asked about the Fed and their policies when it comes to interest rates, he said, look, the Fed looked around and they hurt their savers because they were convenient.
Yeah, well, it had to hurt somebody. And Bernanke had tough choices to make, but he decided to step on the gas pedal in terms of monetary policy, and he brought down rates to virtually unheard of levels and kept them there, and he still got his foot on the pedal, and that really does hurt savers. I mean, it has made it extremely difficult for all kinds of people who live on fixed income investments. But unfortunately, that was a byproduct, and probably Bernanke, and maybe correctly, and I would say probably correctly, decided that the dangers to the economy were greater if he didn't do it.
When it comes to Twitter, Charlie says he stays away from it like the plague. I know you have a Twitter account. You've only tweeted twice. Do you expect to tweet again anytime soon?
It's not been at the top of my mind. Charlie is the only guy less with it than I am.
And you had a really interesting comment today. You talked about the 10 smartest words in economic history. Can you repeat those for us?
Well, it was when George Bush came out in front of the White House and said, if money doesn't loosen up, this sucker could go down. And that summed it up. And incidentally, a number of the members of his party disagreed with his actions during that time. George Bush was right on the money. He needed Paulson and he needed Bernanke, and he needed them to put to the floor in terms of loosening up things. And it worked. And if he hadn't done that, I think the consequences would have been terrible.
When you were explaining why you've been buying newspapers, Charlie at one point said, basically, you're saying it's an exception and you like doing it.
He has a way of saying things, doesn't he? He's right. And we're not doing anything dumb in the sense that we won't get a return on them. But in terms of moving the needle at Berkshire, it'll never do it.
Warren, thank you very much for your time.
Thank you, Maggie.
Appreciate it. Welcome back, everybody. We are coming to you live from GE Capital's Middle Market Summit that's taking place at Ohio State University in Columbus. I'm joined this morning by Berkshire Hathaway Chairman and CEO Warren Buffett. And Warren, you were just talking about how you've been on the prowl looking for big acquisitions around $20 billion or so. A couple of them have fallen through, but part of it is because pricing is so difficult right now.
Pricing's difficult and money's cheap. So we don't leverage our purchases, so we're buying on an all-equity basis. But people that do leverage are getting significant portions of the purchase price at very, very low rates, probably as low as they've ever gotten. So that enables them to bid pretty aggressively. Yeah. And it doesn't factor into our thinking.
But you think at this point maybe some of these acquisition prices are getting a little out of control?
Well, that's the way I feel, but that's natural when you're getting beaten out.
But you won't raise your prices to compete.
No. But we've had a record for bolt-on acquisitions. We've probably done, I don't know, maybe 15 different acquisitions, but they probably only add up to maybe $2 billion or something of the sort. And they're good and they fit in with companies we have. But what I really like is the elephant. So
you're always out elephant hunting.
Absolutely.
With your elephant gun.
Yeah. And they're more likely to come along when either money conditions are fairly tight or something of the sort. Because if you can borrow money at these rates, you can pay a lot of money. And other people, if they pay the wrong price, they walk away from them. But if we pay the wrong price, we live with them forever.
So if these deals haven't gone through, that means you've been looking more aggressively for stocks to buy in the market. As a result, you've got more cash to do that.
Well, we're always looking for stocks, and I've got two fellows that are working for me that are really looking for stocks all the time. But I usually end up buying more of something I already know. Any new company, any new stock I look at, I measure it against the best idea I've got among the present ones. And I'm perfectly willing to just keep adding to the present ones. So it has to beat them. And I know those companies pretty well, so it's a pretty high threshold.
Let's go back to IBM. You were talking just a moment ago about IBM. Have you added any shares to that company in the last couple of months?
Maybe. I don't know, it'd be quite a couple of months. We've added shares this year. We haven't added a lot of shares, but we probably added, it'd be in many hundreds of millions. Wells, we probably added maybe $1 billion worth this year, something like that.
When you first announced your stake in IBM, it caught a lot of people by surprise because you have always stayed away from technology companies. You've said it's something you didn't really understand, and so you didn't want to get involved with it.
Right.
In looking at IBM, you said it was a little different situation. It made sense to you at that point. I guess part of that is the services factor of it.
Right.
But when you look at these big technology companies, it looks like some of them may be maturing. Have you regretted getting into IBM shares at all?
No, I'm delighted to be in it, but and I think they'll probably do better abroad than in the United States over time. But I do, when we buy something like that, I go to our companies and see what they're doing and what they plan to be doing in future years, and how tied in they are with given suppliers, and how much stickiness there is to it. And so even though if you put me in a computer room and spin me around, I'm lost. I just hoping somebody comes here and helps me get out. But I do know what our managers tell me about their plans and the degree to which they're involved. I had one manager tell me something I guess isn't quite repeatable. Nevertheless, in terms of you get pretty locked in sometimes with your supplier.
What's not repeatable?
Well, I asked him how sticky, I won't name the company, necessarily was it when you got in there, and he said, well, it's like getting AIDS.
So it sticks, and it sticks around. It really does. I should bring up the insurance companies because we didn't talk about that before. Jim Cramer had said he's very interested in hearing more about what's happening with insurance because a lot of insurance companies have been doing very well lately.
Yeah.
What can you tell us about Berkshire's?
Well, Berkshire's insurance companies are doing well. I mean, we have about $70 billion of other people's money. We call it float. And when we run it at underwriting profit, that money is just like you gave me $70 billion and I get to earn all the money on it. And this year so far, we've had an underwriting profit. So not only have they given us the $70 billion, but they've given us some more money to hold it. And we get all the investment income from it. So when insurance is good, it's terrific, and it's been good this year.
What do you know about the consumer, not only from the companies you have at Berkshire that you own outright, but from a company like Coca-Cola, and from being able to look around the globe to see how consumers are feeling? There's been a lot of pressure on some of these consumer products companies because prices for commodities have gone up, and sometimes they can't pass those on to their consumer.
But when you think about it, Coca-Cola's been around since 1886. That's pretty amazing, isn't it? And it's the basic product. Now, it's got a whole bunch of extensions, too. But Coca-Cola's physical volume, not dollar sales, but physical volume was up 4% in the first 9 months. And that's in a world that's growing maybe at 1%. So their per capita usage of Coca-Cola products has gone up almost every year since 1886. I mean, Muhtar Kent has done a terrific job running that company. It's a huge distribution machine. In Mexico, I think the number now is up to over 600 plus 8-ounce servings per capita of Coca-Cola products, man, woman, and child, which is at least 50% higher in the United States. And it grows every year. It grew in the first 9 months. It's quite a product.